making money. It's about achieving our deep goals and protecting the fruits of our labor. It's about stewardship and therefore about achieving a good society. With this, on behalf of the Indian Institute of Management, Amritsar, I, Tanisha Soni, along with Sauvik Das, welcome you all to the 8th Finance and Marketing Conclave, PARIPREKSHYA. This conclave stands as a vital platform where future leaders interact with industry stalwarts, gaining insights that will shape our understanding of the rapidly evolving world of finance and marketing. As students and aspiring professionals, the knowledge and real-world wisdom shared today will be invaluable in helping us navigate and influence tomorrow's business landscape. This gathering is not just about ideas, but about igniting our passion to create impactful and transformative changes in our professional journeys and broader business culture. Udyamaha sahasam, dhairya buddhi shakti parakram, shadete yatra vartante, tatra deva sahayakrit. Where effort, courage, patience, intellect, strength and valor are present, there success is assured. May the light bring auspiciousness, health and wealth and remove the darkness of ignorance. So, with the blessings of Goddess Saraswati, the Goddess of Knowledge, I kindly invite our eminent panelists and respected faculty members, Professor Surendra Rao Kumera sir, Professor Riya Singla ma'am and Professor Jagriti Srivastav ma'am to join us on stage to light the lamp and inaugurate this enlightening session.
Now I request everyone to kindly take their seats. I would now kindly invite our Dean of Administration, Professor Surendra Rao Kumera sir, to share his thoughts with us.
Good morning. Right, respected guests from industry, my colleagues and student folks. So once again, I welcome you to this PARIPREKSHYA 2024, the 8th annual Finance and Marketing Conclave. So at the outset, I would like to congratulate our Industry Interaction Cell and our Student Affairs Office for organizing this spectacular conclave. We do meet, quite often, almost once in a month throughout the year. We do meet and discuss on various contemporary themes. Okay, so I appreciate for their efforts, and I also appreciate the Finance and Economics Club and Marco Fili, right, for choosing the contemporary themes for today's day-long deliberations. Okay, in the morning we have the very illustrious industry panel who will deliberate on the prominent issue that navigating global macroeconomic trends and their impact on the financial markets. I believe most of you are here are first year students. How many of you are second year students? Okay, very few, right. So I believe that you are studying the second trimester, right, currently, and you are studying the foundations of finance. I'm sure you are now familiar with what is financial market, and I'm sure you are studying the macroeconomics. Okay, yeah, I'm sure you are going to get benefit out of the morning discussion, I hope, right. So I don't know, how many of you have the introduction to the financial markets or the first-hand experience to the financial markets? Can you raise your hands? How many have the demat account? Right, everyone should have the demat account, everyone should have the demat account. How much it costs, given the technological improvements and the competition in the brokerage houses, the cost of opening the demat account is almost negligible, right? And it doesn't cost really, if you want to start your a first-hand experience with the financial markets, it doesn't cost more than what you spend with your love interest when you go to the CCD on a weekend, right? It doesn't cost. And I don't know what's the payoff of going to the CCD, but I'm sure you will have the better payoff of spending, that money on opening the demat account and buying the couple of stocks. That will drag you to the financial markets, I may ask you to read the newspapers and get updated with that. You will not. But if you have the 500 rupees or the 2000 rupees invested in your demat account and bought a couple of shares, and I'm sure that will help you to look at the financial markets and know what's happening in the financial markets and possibly ask the right question in the classroom. Okay, so I don't want you to invest a lot of money in the financial markets, because I want you to concentrate in the class, because if a lot of money is invested, your mind always will be, when the class is going on, and you will be looking at the smartphone, how your trades are. I don't want that, but I want you to have, whether you specialize in finance or marketing or HR, whatever the area of specialization you want to pursue in your second year. So you need to have some money invested there in the financial market, so that you will be able to update yourself, and you will understand what is discussed in the macroeconomics class, what is discussed in the foundations of finance, corporate finance, what's happening in the various companies. It will help you, so, and you will make better use of the today's morning session, on the financial markets and how the macroeconomic factors influence. Okay, so in this very increasingly interconnected, global markets, understanding how the global macroeconomic trends influence the financial market, because that's what is going to, shape the behavior of financial markets. Not just about the popular macroeconomic variables that you are probably studying in currently, about the effect of inflation, effect of the growth rate, monetary policy or physical policy, how it is going to have the implications to the financial markets and how these policies are set. I'm sure you are studying not just about those aspects. You also need to understand how the trade policies of the major economies, how the technological advancements, particularly the digitalization of the financial markets, and the environmental and sustainability factors, particularly the climate policy changes, how they are going to influence the financial markets, and the geopolitical risks and the political instability, how they are going to affect the trades and thereby affect the financial markets. It's not just about only the macroeconomic variables that you are familiar with from your I don't know, class 8 onwards, you are studying about the inflation, and some of these aspects, and I'm sure you are studying a little more, in the school at IIM Amritsar. Okay, so you just need to, understand the global macroeconomic trends. And if the time permits, I would request the esteemed panel members, to spend some time on your experiences, how the recent geopolitical risks affected the trades, and the trade policies, and thereby affected the financial markets. And I also wanted, because there is some glamour towards the equity markets in the B schools in India and across the world, but there is less glamorous to study the bond markets. And I wanted, because I know we do understand that the corporate bond market is not very liquid in India, but there are a lot of efforts that are being made in order to make it liquid, because the liquid corporate bond market is essential for the effective transformation of the monetary policy. So, and there are a lot of things are happening in the bond market. If you can spare some time in emphasizing the need for understanding, but there are a lot of opportunities for these kids when they graduate in the credit market, if they are motivated to study or push their boundaries a little more and to understand the credit market. If you can emphasize on those aspects, we would be happy to appreciate. Okay, and in the afternoon you have a very energetic panel members from the industry. They will be talking about the physical marketing. I really appreciate the Macroeconomic. A couple of years back, when they discussed about when they chose the topic of metaverse marketing. I don't know how many of you have heard about this term, metaverse marketing. It was a great experience for me to sit there and understand what is metaverse marketing. I'm not a marketing guy, but I really appreciate it. And this year they chose the topic of digital marketing. I am one of the beneficiaries. I'm sure many of you are the beneficiaries of AR tools, that are available on most of the e-commerce platforms, and particularly I use when I wanted to shop an IKEA in Hyderabad. I don't need to go to the mall. I can use their AR apps. That really enriched the shopping experience. Okay, I'm sure in the today's day-long discussions you will benefit from you will hear out from the industry experts and how they are dealing with the various aspects, and I'm sure you will benefit from the day-long discussion. I hope I wanted you to take at least a couple of things out of this hall, when you leave and go to your hostel rooms. These are the couple of things I learned. That would be the great value addition. Sir, we at IIM Amritsar, we do conduct these conclaves almost, once in a month throughout the year on various themes, contemporary themes, and we also, invite the industry speakers to the classroom. Our objective is these events will bridge the gap between the industry and academia to a greater extent. And we consciously took the decision to encourage the student activities. These are the student-initiated activities. And also this will benefit the students to get to know what's happening and what the industry grappling with. Okay, so as an institute, we are entering into the second decade, and at this point, we are offering the 2-year MBA program, and most of these kids are from the two-year flagship program, and this is a MBA, general MBA program, and we also offer the MBA in Business Analytics, MBA in HRM, and to cater to the working professionals, we do have the Executive MBA program. And we also have the collaboration with the IIT Roper, and we offer the data science program, postgraduate data science program, and we also have the PhD program, and we host postdoctoral fellows, to add to the research, on the thought leadership in this country. That's what we are doing here. But yeah, at the end, on behalf of the entire IIM Amritsar fraternity and our director Nagarajan Ramurthy, who had to travel today, is not around today. So right, so I really appreciate for your time and presence here, and I hope we will continue to connect and build on this association. Thank you, and I hope you will have a very enriching day. Thank you.
for sharing your valuable thoughts. Now I will comprise the topic, the theme of today's, navigating global macroeconomic trends. Unveiling the impact on financial markets explores how factors like interest rate policies, geopolitical tensions, and supply chain disruptions shape global markets. By understanding these economic forces, participants gain insights into managing financial risk and opportunities in today's volatile landscape. This theme empowers future leaders with knowledge of macroeconomic dynamics, preparing them to make informed decisions that drive stability and innovation within the increasingly interconnected financial world. And for that, we are pleased to welcome Ms. Vansita Surya and Mr. Ishan Khurana to present today's theme.
Good morning, distinguished guests, industry leaders, and our esteemed colleagues. This is Vansita Surya, along with my colleague Ishan Khurana. Together, we welcome you all to the 8th edition of PARIPREKSHYA, the annual finance and marketing conclave of IIM Amritsar. Today, we all stand at the intersection of unprecedented macroeconomic shifts that are redefining the global financial landscape. From inflationary pressures and evolving monetary policies to technological disruptions and geopolitical tensions. These forces are not just shaping markets, but altering the very foundation of how we engage with finance and investments. But the question is, how have these recent macroeconomic trends impacted our strategic financial decisions?
This graph illustrates the global macroeconomic trends over the years, showing the GDP growth rate and inflation rate for a period of 2000 to 2030, depicting how global events like global financial crisis and pandemic impact these economic indicators. We observe a steady increase in the GDP, followed by some fluctuations, especially around the 2020 period. This dip is likely due to the COVID-19 pandemic. Post-2020, GDP began to recover, showing consistent growth into the future projected years. Unlikely, the inflation rate fluctuates independently of the GDP growth rate. It remains relatively stable for the initial years. The peak in the inflation is likely related to the supply chain disruptions and increased demand.
One of the most influential economists shaping the European monetary policy dynamics and the president of the European Central Bank, Christine Lagarde, once said, "Globalization has altered the economic engagement. Understanding macroeconomic trends is now imperative for staying competitive." With this thought, let me hold the privilege to introduce you all to the theme for the conclave. Navigating global macroeconomic trends, unveiling their impact on financial markets.
In this presentation, we shall explore the following topics, beginning with the key macroeconomic trends and their role in shaping the future of the financial markets, challenges and opportunities in the current global landscape, protectionist policies and their impact on the global trade and financial flows, technological and economic changes driving the long-term shifts, and industry-specific outlooks beginning from finance to agriculture on how these key sectors are evolving.
Now let us begin with the key macroeconomic trends. On the very first we have is inflation. According to economists, inflation can be defined as too much money chasing too few goods. We see that the current global inflation rate stands at 5.9%, whereas India sees a lower inflation, moderated to 5.49%, driven by its effective policy measures and strong monetary and fiscal synchronization. The key drivers of inflation are monetary policy, that has measures like expansionary and contractionary policies impacted by the central banks and forces in an economy, the fiscal policies having tax reforms with some standard deductions and overall government spendings, the demand pull inflation impacted by the interest rates, consumer spendings and other significant factors, along with the cost push inflation with rising overall input costs in an economy, supply chain disruptions and other drivers directly impacting the inflation rates of the economy.
Moving forward, the next macroeconomic trend we are looking at is the interest rates. We can see that India has had a stable interest rate journey throughout the years. The stable repo rate and reverse repo rate stands at 6.5% and 3.35% respectively. Other major economies are still maintaining higher interest rate to combat persistent inflation. Balancing credit growth with financial stability remains a critical issue. Additionally, the Fed rate changed to 4.83% in the need to counter the economic disruption and the recession experienced in the wake of COVID-19 pandemic. The factors affecting the interest rate in an economy are credit worthiness, political stability, inflation, exchange rates, government policies, and economic growth. While the impact of changes in these interest rates are reflected in the following: borrowing cost, investment decisions, stock market volatility, global economic conditions, and money supply.
Now as we look at this graph by the International Monetary Fund, we infer that there is a substantial rise in the policy rates across major continents in the period of 2022 to 23, reflecting the central bank's response to global inflationary pressures impacting the financial markets by tightening financial conditions influenced by the US Federal Reserve, the global market expectations, and an emerging market volatility.
As we understand these key macroeconomic variables, let us know how these are impacted by some of the geopolitical events faced by the world. First of all, the Russia-Ukraine conflict and the Israel-Hamas are driving tensions as they continue to disrupt the energy supplies, leading to an increased volatility in the energy prices. Secondly, the US-China trade war impacting the tariffs and trade restrictions, which are reshaping the global supply chains and impacting industries as a result. OPEC's production cuts, making adjustments in the oil production levels, which are having significant implications on the global energy prices and inflation. The world has also seen major events like COVID-19 pandemic and global financial crisis that have had major consequences. These geopolitical events have impacted the global financial markets by disrupting the global supply chain, significant long-term consequences, currency depreciation, uncertainty and lack of investor confidence, and lastly, increased costs for businesses and consumers.
To see the impact of these mishappenings, this graph here depicts the geopolitical risk, threat and act indices for a period of 20 plus years, showing their dips and peaks by the impact of these significant events mentioned over years. These geopolitical indices are used in tracking news stories and events to measure the risk levels. The data is often gathered through advanced algorithms that analyze the news articles and reports from global sources.
Let us now briefly take some glimpses on the impact of these global events on the Nifty 50 index of India. The first chart represents the Nifty 50's performance during the 2008 global financial crisis. As we can see that initially the index experienced a significant downward trend. This was a period of massive financial instability due to the collapse of major banks and financial institutions worldwide. Investors faced huge uncertainty, which led to a sharp sell-off that drove Nifty 50 downward drastically. The index saw almost a 60% decline by the end of 2008, reflecting the depth of this crisis.
The second chart here shows the impact of the COVID-19 pandemic on Nifty 50 in the early 2020. Similar to 2008, the onset of the COVID-19 triggered the widespread panic in the markets. As the virus spread and lockdowns were imposed globally, the market reacted to the looming economic downturn. By March 2020, Nifty 50 plunged as investors feared the impact of reduced economic activities and corporate earnings. The index dropped from around 12,000 points to below 8,000 points within weeks, a steep decline that reflected the unprecedented nature of the pandemic.
In this chart, starting from the early 2022, when the Russia-Ukraine conflict intensified, there was a noticeable decline in the market. In February, the Nifty 50 reached a peak, but as the conflict intensified, investor sentiment weakened, resulting in a heavy sell-off. By March, a noticeable dip occurred, and as the fears around the prolonged conflict escalated, and the downward trend continues into April and May. Throughout this period, the Nifty 50 index attempted slight recoveries, but overall it moved in a downward trend, reflecting the negative impact of the Russia-Ukraine conflict. By June, the index hit a low point, underscoring the sustained impact of the geopolitical situations on the Indian markets.
Let us now move towards one of the most prominent economic reflectors, the GDP. Our GDP growth is driven by 4 key factors: domestic consumption, government infrastructure spendings, private investments, and exports and imports. The GDP forecast shows a significant growth from $2.84 trillion in 2019 to a projected $6.44 trillion by 2029, reflecting the robust expansion trajectory. On a global scale, India is positioned as a leader among emerging markets, with real GDP growth rates of 7.6% in 2023, outperforming advanced economies like the US and Euro area. This growth reflects India's pivotal role in the global economic landscape, particularly in the emerging and developing economies. Moving ahead, the graph here highlights India's GDP growth in the current crisis from 1987 to 2029, showcasing a consistent upward trajectory. This trend underscores India's growing economic significance amid the global macroeconomic shifts. Key global factors such as the shifts in trade policies, currency fluctuations, inflationary pressures have directly impacted India's GDP growth trajectory. India's GDP spike, especially in the recent years, reflects resilience against global uncertainties like trade wars, COVID-19, and geopolitical tensions. Such robust economic growth amplifies India's appeal in the financial markets, attracting global investors seeking the growth opportunities. While understanding these dynamics is vital for stakeholders navigating the complex interplay between the global macroeconomic trends and market outcomes.
As we have overviewed the key macroeconomic trends, it is now time that we look into the significant challenges in shifting the global interest. Some of the key challenges faced by the financial markets are ongoing conflicts in the Eastern Europe and the global trade tensions are causing capital to leave the risky markets. This is destabilizing the local economies and affecting the global investments. Countries are putting tariffs and trade restrictions to protect their own industries. This disrupts the global supply chains and changes the trade patterns. Many emerging markets are seeing their currencies lose value, leading to higher inflation and making imports more expensive. Financial institutions are holding more assets in the offshore accounts to take advantage of the lower taxes and flexible regulations. The failure of any large institution could have a domino effect, impacting the financial systems worldwide. Regulators are finding it hard to put safeguards in place to manage this risk. While more credit is helping the economies grow, it is also raising concerns about global debt and whether it is sustainable for the long term or not.
With these challenges playing an important role in shaping the financial markets, we see the opportunities in a dynamic space as the global capital markets are increasingly exploring non-traditional investment avenues from emerging markets to alternative asset classes to minimize the regional risk and enhance returns, allowing investors to access a broader range of opportunities amid the economic fluctuations, creating resilient portfolios with global appeal. The sustainable finance initiatives have started gaining momentum, driven by investors' increasing preference for environmental and social responsible options, supporting the long-term environmental goals, reducing risk associated with climate change, and aligned with the global sustainability goals, presenting vast opportunities for growth in green bonds, ESG funds, and carbon credit markets. The global supply chain realignments have consistently reorganized the global supply chain and reshaping the investment landscape, particularly in the company's diversified sourcing and production to mitigate the geopolitical risk, creating opportunities in regions with the emerging manufacturing hub. The technological innovations in finance like AI, blockchain, and the digital assets are started transforming financial markets by improving efficiency, accessibility, and security. From automated trading and smart contracts to decentralized finances, these technologies offer investors new avenues to capitalize on cutting-edge financial products and democratize access to sophisticated investment tools. Lastly, the global regulatory reforms are reshaping the financial systems to promote stability, transparency, and investor protection. These reforms, driven by the changing economic and political landscapes, offer opportunities by creating fairer market conditions, encouraging the ethical business practices, and fostering growth through compliance with evolving standards in a rapidly integrating global economy.
Now, let us have a look at the protectionist stand and their impact on the global financial markets. Protectionism, largely characterized by tariffs and trade restrictions, leads to several macroeconomic consequences. The impact of protectionist moves include reduced foreign investments, trade disruptions, currency fluctuations, higher domestic inflation, strategic risk in global partnership, supply chain realignments, market fragmentation, and sector-specific volatility.
To illustrate more on this, let us look at the US-China trade war. Its timeline between 2018 to 2020 highlights escalating tariffs that significantly impacted the global financial markets. These tariffs led to market volatility, with the S&P 500 experiencing a steep 6.6% decline and contributed to the depreciation of the Chinese yuan as China countered US protectionism. The trade tensions also influenced other markets, with broader UK stock indices and domestic sectors being negatively affected. The trade war underscored the ripple effects of protectionist policies in global markets, forcing investors to navigate increased uncertainties. This scenario highlights the profound impact of geopolitical tensions on financial stability and investment strategies globally. Protectionism may serve as a short-term shield for domestic industries, but its long-term effects can stifle the global trade. Understanding the dynamics of protectionism is essential for navigating the current and future landscape of global financial markets.
Moving forward, let us see the long-term impact of technological and economic changes. First of all, the world population is changing vigorously. In countries like Japan and some parts of the Europe, people are getting older, putting pressure on the healthcare and retirement systems. But in countries like India, where the population is much younger, about 65% of the population is under the age of 35, this means that India has a lot of potential and energy for growth, which could make it a bigger player in the global economy. Well, technology is evolving finance. Innovations like blockchain, through securing ways of recording transactions, help make these financial systems safer and clearer. In India, fintech is growing really fast. Digital payments like UPI are expected to reach over $10 trillion, showing how quickly digital money is becoming prominent here. Speaking of the global power, it is expected that by the end of 2024, China's share of the world's economy will be 18.2% and that of US will be 17.4%. This shift means that two of the world's biggest economies will be even closer in power. We are also experiencing some countries trade very less with each other in the view of deglobalization, such as the US-China trade disagreements and Brexit referendum. By the end of 2024, global trade could be 15% less than it might have been without these issues, and many companies are looking forward for suppliers closer to their home to avoid this risk. Well, sustainability is another big focus around the globe. Green investments, especially in the solar energy, are growing really fast thanks to the efforts led by European Union and China. Many governments are also setting stricter carbon rules to meet the goals, like the Paris Agreement's target of zero carbon emission by 2050. Lastly, automation and AI are changing jobs. It is predicted that while the 85 million job roles will go away, 97 million new ones will be created in the areas like data science and artificial intelligence. This change means that a lot of people, especially in the countries like India, will need new job roles and skills for these future job opportunities.
As we have delved into the key drivers of the global economy, it is now time that we look at the transformations in significant industries and the impact of the changing financial aspects. Starting off with the global finance industry, a rapid growth in banking assets, with the top 100 banks collectively manage over $70 trillion by 2024, highlighting the resilience of the global banking sector. The graph here depicts the growth in deposits from 2016 to 2025. The deposits have had a significant jump in 2020. The deposits are projected to reach beyond $2,500 billion by 2025. On the other end, the 10% drop in the net income for many banks across Europe and US in 2024 is indicative of broader economic pressures. The declining net interest margins are not just a reflection of the market fluctuations, but also a growing concern for overall profitability.
Let us now look at the consumer goods industry. Geopolitical tensions, including the US-China trade war and Russia-Ukraine conflicts, have led to a 5 to 7% decline in the global trade volumes in the consumer goods sector. The chart here tracks the global consumer confidence, and we can see a sharp drop in the confidence at the start of 2020. This is due to the COVID-19 pandemic. It gradually recovered but had other dips as well. Interestingly, the confidence in the emerging markets has been consistently higher than in the developed markets throughout this period. Moreover, sustainability is becoming a key factor in purchasing decisions of the customers, with 42% of them prioritizing the brands with greener packaging and sustainable sourcing.
Next up we have is the technology industry. Let us take a look at the graph first. It shows the growth of the global information technology market from 2023 to 28, which is projected to reach beyond $12,000 billion by 2028. This represents a compound annual growth rate of 8.3%. In contrast, China's projected economic slowdown, with growth to decelerate to 3.7% by 2035, is said to have ripple effects across the global tech landscape. Meanwhile, cyber attacks surging by 35% in 2024 has increased the cybersecurity spends by 20%, which is essential for companies to protect themselves against these threats.
Moving ahead, let us overview the manufacturing industry. With the global unemployment at a low of 3.5%, there is a shortage of skilled labor. This has pushed the manufacturers to adopt smart factories, helping them cut costs and maintain and handle the economic ups and downs. As shown in this chart, unemployment trends vary across income groups. High-income countries had the lowest rates and have bounced back quickly after the 2020s spike. Upper middle income countries saw higher rates and lower middle income countries had the highest rates, especially in the 2020. Low income countries faced high unemployment too, with slower recovery compared to the other groups.
Getting to know about the agriculture industry, we see that the global agricultural trade remains a critical part of the world economy. But price volatility is forcing farmers to navigate unpredictable market conditions. The chart here shows the projected growth of the global agriculture market till 2028. It tells us that the market is expected to grow at a compound annual growth rate of 7.7%, estimated to reach beyond $19,000 billion by 2028. This growth indicates a positive outlook for the agriculture industry in the coming years. The global supply chain disruptions led to the shipping cost rise by nearly 20%, escalating the food security concerns in many regions.
Learning about the energy industry, we see that in the last 2 years, clean energy jobs have grown by 10%, highlighting the sector's impact on the job creation and economic growth. It has been forecasted that by the end of 2030, renewables are set to provide 70% of the global electricity, stressing the need for more green investments. Now, as we can see in this particular chart, oil use is leveling off, natural gas continue to grow, and coal is declining due to environmental concerns. Nuclear remains steady and hydroelectricity is expected to stabilize. The big story is in renewables, with solar and wind being the fastest growing and are expected to lead all the energy sources by 2050. This shift shows a strong move towards a sustainable future. Having covered the key insights, I will now pass it over to Vanshita to lead us through the conclusion and tie together our discussion towards these critical macroeconomic trends.
Thank you, Ishan. Ladies and gentlemen, as we draw to a close, let's take a moment to reflect on this pressing theme of navigating the global macroeconomic trends, unveiling their impact on financial markets. We have seen the substantial influence of macroeconomic forces on the financial markets, driven by pivotal factors such as interest rates, geopolitical risk, and technological advancements. Interest rates remain a cornerstone of the global financial stability, affecting the economic growth, policy directions, and the currency movements. Shifts in the geopolitical dynamics have likewise reshaped the financial landscapes, as seen in the surge of risk premiums and currency fluctuations alongside more protectionist trade policies. In emerging markets like India, while protectionism has sparked the local economic resilience, it has also intensified challenges within the global supply chains, adding layers of complexity to cross-border trade and investment strategies. On the industry front, technology, energy, and agriculture have each encountered profound changes. Technology sector is projected to grow 8.3% annually till 2028. Cybersecurity spending has surged by 20% to counter the growing threats. In the energy domain, we are witnessing a significant transition, with renewables projected to account for 70% of the global economic electricity production by 2030. This shift not only aligns with the climate goals, but also demands massive investments, estimated at $1.7 trillion by the decade's end. Agriculture sector is also expected to grow at 7.7% annually by 2028. These statistics reveal the need for agile, resilient investment strategies. Financial markets are responding through capital diversification, sustainable finance initiatives, and technological innovations. Capital diversification into emerging markets and alternative assets mitigate regional risk, while sustainable finance channel investment through environmental and social goals. Lastly, meanwhile, the technologies like AI, blockchain, and automation not only democratize the market access but also increase efficiency and transparency across sectors. As we reflect on these trends, let us challenge ourselves to be the architects of transformative financial landscape. The future demands that we not only adapt but also innovate, create solutions that drive sustainability and resilience. Together, we have the power to redefine success and build an inclusive economy that benefits all. Let's lead with vision, courage, and purpose as we navigate the complexities ahead. Thank you.
Thank you, Vanshita and Ishan. Your presentation was informative and thought-provoking. Let us now welcome Professor Pankaj Gupta, sir. Thank you, sir, for joining us. Let your deeds illuminate the path, not the glow of your own ambition. Led by inspiration and elevation, the truest measure of leadership lies not in your own assets, but in the lives you lived and the legacies you leave. With this being said, let us welcome our esteemed keynote speaker, Mr. Pankaj Garg. Mr. Garg, CFO of Sleepwell Group Holding Company, is a distinguished finance professional with over 30 years of extensive experience and a solid academic foundation. A chartered accountant from the 1990 batch. Mr. Garg graduated with a BCom honors from the prestigious Sri Ram College of Commerce, Delhi University in 1987. Known for his academic excellence, he was a gold medalist at the 10+2 level and a merit rank holder in his CA examination. In the early years of his career, he contributed to prominent multinational corporations such as GSK, PepsiCo, and Nestle, gaining crucial insights into the FMCG sector. He later transitioned to the infrastructure industry, where he held senior roles in major Indian conglomerates like Jindal Steel and Ultratech. His commitment, expertise, and strategic leadership eventually led him to the position of CFO at Dalmia Bharat before joining Sleepwell Group Holding Company as its CFO. His diverse industry experience enables him to drive financial strategy and leadership with insight and precision at Sleepwell. We would like to request Professor Surendra Rao Kamera sir to come on the stage and felicitate Mr. Pankaj Garg. Thank you very much, Professor Surendra Rao Kamera sir. It is with the utmost reverence that we humbly request Mr. Garg to deliver the keynote address.
First of all, thank you very much. I feel honored that Institute of Indian Institute of Management has invited me for this keynote speaker address. We have been, as students, you must be, juggled with so much of financial terms every day, and you must be thinking that when I really go to the market or to the industry, how would I, convert these theories or numbers into really making money-making machines. So I'll give you one example from my own experience. In just after the pandemic, the interest rates went down. So when the interest rate went down, it has an inverse relationship with the value of a particular instrument. It can be a bond, it can be in fixed deposit, it can be anything. But how do I convert this particular information into a profitable proposal? That is one part. And second, when the interest rates start rising, just after 2 years, somewhere in 2022, the interest rates started rising. Now, how do I make money when the interest rates are rising? When the interest rates are going down, automatically the value of my investments go up. I don't have to do anything. If I am invested into a product where the interest rates are going down, the value goes up. So nothing to be done. But when the interest rates are going up, what should I do? How do I make money? Because every investment which you have, the value goes every time Shaktikanta Das increases the rates. And it has already gone up to 6.5%, which we have noted. And third part is that based on these information on interest rates, how we convert them into a profitable proposal for the organization and for the industry. So 3 examples I would like to give. First, when the interest rates were going down, the value of my investments were going up. So that was a profitable venture, there was nothing to be done. But how do I convert into more money? Always looking for more money. So what we did, that we started investing into the products which had a higher interest rates. So we moved the investments. Give you an example of Yes Bank. If you remember, somewhere in the pandemic, the Yes Bank went down and the value of the equity became 0. So that the impact of the same was that all the 81 bonds of the banking industry were in doldrums, and there were no buyers. So we were the first one to jump in. Every information which you read, if you can convert into a profitable opportunity, that is what would be expected from you when you go to the industry. Similarly, when the interest rates are going down, interest rates are going up in 2022. At that time, the opportunity was that if we have a profitable venture where the interest rates being lower, can we take advantage of the situation now and use this particular opportunity for our profitable ventures? For example, there was one of the acquisitions which were pending. It was lying in a Thanda Basta diagnostic, because the interest rates in India normally we consider as benchmark between 8% to 10%. And if any of the project is giving you a profit of what 8 to 10%, then you would not like to invest. That was the theory being built. So the same theory was given to me when I joined this organization somewhere in 2019. So I said, I can change this theory because the pandemic has given an opportunity. Interest rates worldwide are almost 0 or negative. If you remember, Euribor has become negative, and that was considered as 0. And the margins beyond the Euribor was something like 1%, 1.5%. So we said, this is the opportunity. Let's acquire the company, because the situation in the world, especially in the Western world, is very precarious. So we did this acquisition of about 40 million euros in Spain. Now the challenge was that how do we make money without investing even €1? So we have to find out a financial partner where he would invest on behalf of us, believing on us, our theory, and that should be profitable. So, broadly speaking, the EBITDA levels of this company, the target company, was about 9 to 10%, And if the interest rates are something like 1.25%, so we make a clear EBITDA of about 8% on this acquisition, and that too without any investment from our pocket. So this was a what we call, converting an information into a profitable venture when the interest rates were down. Now I come to the current situation, and again I'll talk about the interest rates only. That's my sort of a favorite area. As of now, if you see, the interest rates across Western world are going down. Like Mr. Powell has decreased twice, 50 basis point, and day before yesterday, 25 basis points. Now this is an information, and people who are holding, for example, US Treasury bonds, they must be happy because the value goes up, the interest rate goes down, the value goes up. But how do I make this information useful for my company or for my group of companies? Because I have investments in Spain, I have investments in Australia. So how do I make this information profitable for us? So there is a concept you must have heard, interest rate futures. But probably it's more of a theory when we read it, and when we go to the industry, we just forget about it. Because we don't find real practical use when we reach to the industry. But we really used it in India as well as in US. In India, what we have done, since the interest rates, which we all of us know, that either end of this fiscal year or maybe beginning of the next fiscal year, the interest rate will go down. So we started investing in interest rate futures. So every interest rate which you have, every futures which you have invested is giving you approximately 40 times of the multiplier, the amount of investment. For example, let's say you want to trade approximately 100 crores worth of GSECs. In 100 crores worth of GSEC, either you need 100 crores or you go to the futures. But there should be strong conviction, there's a strong calculation that we would be able to make money on this. For this 100 crores, you need only 2.5 crores as investment. As of now, today, we are sitting on 700 crore of worth of interest rate futures. And we intend to make something like 8 to 10 crores for every 100 crores. That kind of money we can make on this interest rate future theory. But so why I'm giving you this example, that try to assimilate your theories, your information, your studies into a meaningful business proposal which can really change your fortune and give you a sense of achievement also in your life, in your career. And second, you become more and more creative, innovative when you really apply your theories into practice. I'll give you one more example, my experience, where you can take advantage. Sorry. I'll go back on one more information, slightly older. This was an acquisition in Germany, and the size of the company was not very large, about 100 crore, but in terms of size and in terms of top line. Whereas top line and the acquisition cost were same. The challenge was that a market which we normally understand in our studies, that Europe is a stagnant market. So why we are entering into Europe? How does it, gel with our current business lines, and will it really make profitable when we enter into Germany especially. So there were two challenges. One was naturally the funding of the same, and second was the what kind of value additions we will do when we acquire this company. So what we did first, based on the project report, we studied that. We found that there are two opportunities. One, if we acquire this company, then all the products which are manufactured by us, which are similar to this and which we are selling in the Western world, now they can be branded as being labeled as the German company. So that's the first advantage we get. And second is we will also learn the new technological innovations which this company has done and implement those in India, which is a normal course of business when we acquire a better company than us. So we use this particular strategy and acquired this company and made all the products which are manufactured in India. They were now exported to various Western countries at a higher price. So what I'm trying to say that sometimes on a paper you will feel that this company which you are acquiring will not give you the much profits which you calculated because of the biased mind that Europe will not give you any profitable venture in terms of volumes, in terms of pricing. But if you add your own quantities manufactured in India and label them as being manufactured by the German company, so it will give you money. So the same concept you can apply in your practical life also whenever you are making a proposal or you are considering that something is impossible or not being able to implement it. One last example, then I'll close down, because if I continue sharing, I'll eat up everybody's time. One proposal came to me somewhere in 2018. A salesman wanted to sell a product or sort of export the product to a dealer in Italy. And this Italian dealer said, I will pay you when I sell it, really sell it, and when I get the money from the manufacturer to whom I sold it. The whole process, which he explained to us, that 45 days of sailing from India, and then something like 90 days of stock keeping with him, and then normally he believes that another 120 days it will take to get the money from the customer. Now on the face of it you will feel that why we are doing this, we are selling something and we are not getting this money, and it will take hell lot of time for 8 to 9 months. So they were most of the people in the meeting said, I think we should not take this proposal because we are not sure of getting our money, and even if it is giving a profit of about 18-19%, it doesn't make sense. So what we did, we found out a credit insurance partner in Europe, and this credit insurance partner, we told them gave him the details of this particular deal, and this deal said yes, he can take a guarantee, and he can also get to know about a financial model where he will give us the money right at the time of exporting it. So the cost of both, the insurance cost and the discounting cost, if we reduce it, we will get about 16%. So what I'm trying to say that sometimes on the face of it you will realize that this proposal is useless and we should not go ahead with this. But if you dissect it and divide and have your own experiences from different countries, then you can find that such kind of proposals are acceptable, but you need to present it in a better way. So that's it from my side. Thank you very much. Thank you very much to the faculty again.
We extend our heartfelt gratitude to you, sir, for sharing your enlightening and profound insights Your presence at this event is truly cherished. Thank you. I kindly request you to take the seat on stage, sir. Starting with Ms. Nana Mehta, Senior Finance Director at PepsiCo India Capability Center. Ms. Nana Mehta is a prominent leader in finance with over 20 years of extensive experience across global companies. As Senior Finance Director at PepsiCo India Capability Center, she spearheads financial strategy and operational excellence, driving impactful results and fostering a culture of growth and innovation. Prior to joining PepsiCo, Ms. Mehta held senior roles at esteemed organizations such as Tata Consulting Services, HP, and Shell, where she contributed significantly to financial planning and analysis. Her leadership of Hyderabad Green Team at PepsiCo showcases her dedication to sustainability. Ms. Mehta is also a champion for women empowerment, actively contributing to various networks and receiving the Herky Rising Award for Women in Finance. Ms. Mehta ranked second in India in the CIMA Strategic Case Study exam. Her educational credentials include an MBA, CIMA, CGMA, and FP&A certifications. Beyond her professional life, she is passionate about cooking, reading, and traveling.
Up next, we have Mr. Desh Angle, Vice President Finance, Birla Soft. Mr. Angle is a distinguished finance leader with over 25 years of multifaceted corporate finance experience spanning in industries such as IT services, software, BPO, and manufacturing. Currently serving as the head of Global Corporate Finance and Chief Risk Officer at Birlasoft, Mr. Angle oversees critical functions including financial planning and analysis, strategic financial planning, P&L management, and enterprise risk management. Throughout his career, Mr. Angle has successfully led finance functions in global corporations, contributing expertise across roles such as business CFO and mergers and acquisitions. Before joining Birlasoft, he was the Director of Finance at Capita, where he headed the finance operations for the India Digital Development Center. His tenure at IBM India further enhanced his profile with roles such as CFO for the Infrastructure Services BU and Treasurer for the India South Asia region. Mr. Angle has been recognized as a CFO Next 100 awardee by CFO India. Beyond his professional pursuits, Ms. Angle is an avid badminton player and enjoys listening to classic Hindi music.
Next on the list, we have Mr. Durga Das Shinoy, Director of Finance Planning and Analysis, Amadeus. Mr. Durga Das Shinoy currently serves as the Director of the Financial Planning and Analysis at Amadeus. A chartered accountant with over 24 years of experience, he holds a Certified Public Accountant certification from the United States. An alumnus of Indian Institute of Management, Bangalore, Mr. Shinoy has a strong interest in behavioral economics, leadership, and management. He has previously worked with esteemed organizations such as Alcatel, Lucent, Ernst & Young, and Deloitte. His expertise spans audit, accounting, treasury project accounting, and financial planning. Outside of his professional life, he is an avid reader. He also enjoys spending time at the beach, admiring mountain landscapes and traveling between the two by motorbike or car.
The next member of our esteemed panel is Mr. Manan Vaishnav, Head of Securities, Society Generale. Mr. Manan is the Head of Society Generale, Securities India Private Limited, a division of the globally renowned Society Generale Corporate and Investment Bank. With over 2 decades of expertise in equities and F&O in research, trading and client management, Mr. Manan has worked with some of the world's largest hedge funds. His skill in helping FPIs access India and providing bespoke analysis sets him apart. An adventurer at heart, Mr. Manan's love for high-altitude trekking has seen him conquer iconic trails, including the Everest Base Camp and Rupkund Trek and Surpass Trek. His journey reflects not only professional excellence, but also a spirit of adventure and resilience.
Up next, we have Mr. Animesh Agarwal, Vice President Finance Product. With over 18 years of experience, Mr. Animesh Agarwal is a recognized finance leader skilled in FP&A, global investor relations and corporate finance across tech giants like Cognizant, Cyient, HCL Tech, Tech Mahindra and Infosys. Currently, he serves as the Vice President of Finance at Product Solution, a leading company in the connected domain with operation in over 30 countries. Previously, he led Cognizant CMT Business Finance Group, managing $1 billion in annual revenue. Mr. Agarwal has managed investor relations for companies with market cap from $2.2 billion to $42 billion, spearheading initiatives in large-scale M&A multi-million-dollar cost and automation projects that drove substantial market cap growth. An active member of finance forums, he holds accolades such as BW CFO World's Finance 40 Under 40 in 2023 and the Indian Achievers Award 2022. His qualifications include the CFO program from the IIM Calcutta, CMA, and an MBA in finance from the Great Lakes. Now, I would like to take the opportunity to invite all the panelists along with our keynote speaker, sir, on stage. I would like to call Professor Jagriti Srivastava ma'am on the stage to felicitate our esteemed panelists with a token of appreciation. Thank you, ma'am. I would request Ms. Nana Mehta to take the lead of the conclave and commence today's discussion.
Thank you so much. Good morning, everyone. How are you all today? Awesome. So I get the privilege, one, to be part of this extremely dignified panelist group and also moderate the session. So be with me, and I think I would continue with what Pankaj just said. And you spoke so much on interest rate, right? I completely agree. Interest rate volatility is actually driving a lot of global liquidity. And interest rate, in fact, is the center for a lot of economic decisions like, say, consumer spending, to business investments, international trade, and, say, capital inflows. Okay, you spoke so much about how interest rate advantage could be taken even in adverse situations. And I would like to actually, extend the topic and ask, what do you think the implications in general, and not specific to any particular industry, would be on the liquidity, global liquidity, in light of interest rate fluctuations, really volatile in the recent years, moving both sides, right? It's just not one side, it's volatile both sides.
गुड मॉर्निंग अगेन. आई थिंक पंजाब में आए हैं तो सत श्री अकाल तो बनता है. ओके, तो इंटरेस्ट रेट वॉलेटिलिटी जो नैना ने बात की, दिस इंटरेस्ट रेट वॉलेटिलिटी अभी वी हैव सीन recently one from the Japan where suddenly the interest rates they changed and the world saw what's this happening. They never changed the interest rates in Japan. So it was considered to be a stable currency, stable country in terms of investments, in terms of arbitrage between US and Japan. And they decided, and the whole world, which is what we call the finance world, which lives on interest rates differentials or the arbitrage, it gone crashing in the stock markets, went down by 10% the moment they announced this. This is one part, just keep it in one as a bookmark. Second is the interest rates which Mr. Powell announced in the month of September that we are reducing it by 50 basis points. Now normally on the normal parlance you will believe that this 50 basis points will further reduce by another 50 basis points by the end of the year, which was going to happen. But suddenly in the month of September, somewhere in September end, the things changed. The actual interest rates of the US 10-year bonds, they started going up. And nobody could imagine that what's happening this, why this is happening. And we only came to know about 2 days ago when Mr. Trump won the election. And then we understood why the interest rate is going up, because market started discounting or factoring in the interest rates will go up when the Mr. Trump comes in, because he will reduce the tax on the corporates. He will also reduce the interest rates, which will again go for higher inflation, and all these factors will sort of strengthen the dollar. Now all these factors, the two different parts, which what's happened in Japan and what's happened in US, is unpredictable. Nobody believes that Mr. Trump will come and inflation will go up. Now the question before us is, how do we make benefit of this? There are two ways to make benefit of this. We have to predict that if the interest rates, the real interest rates which are in US as of now, have they peaked now? Because what we saw 2 days ago, when Mr. Powell reduced the interest rate by 25 basis points, there was hardly any impact in the real marketable yields of the bonds. The small bonds went down, again they went up. So I strongly feel that it has peaked up. If we want to invest into US bonds or what we call the fixed income market, this is the right time to enter and wait and watch. These interest rates will go down and take advantage of the situation. So it means that we should keep invested into US bonds, whether they are 10-year. Personally speaking, as our office, we are heavily invested into now 30 years US Fed. So that will give us, every 1 bips will give us about 12 bips. So multiplier is 12. So take advantage of the situation now, invest into US 30 years and you will make money.
This is like a tip for investing, and I'm definitely going to go back and do that. I'm not an active investor on bonds. I've never understood the bond market. I'm an active investor in equity, and hence I would go back to my favorite topic. Whenever there is a news on interest rate or speculation about an interest rate, where do you first see the impact? You see it on your financial market, especially on your equities, right? Equities and derivatives. And India is prone to all of those volatility, and of late we've seen really volatile markets, right? And especially after COVID. So Manan, this question is to you. In light of India and in light of financial markets, where do you see this volatility impacting? How does interest rate drive all of these unprecedented changes, or how does it impact the market, if I have to just put it?
Thanks, Naina. So first of all, I think whatever I'm going to say, some of it ties up into the presentation which was made by the students of IIM Amritsar. And I think it was a very well-made presentation. So kudos to you for that. The second thing is, whatever I'm saying is my own personal opinion based on publicly available data. So it cannot be attributed to any of my employers, past or present. Having put that disclaimer aside, I think 3 trends have emerged in the India's equity and derivatives markets in the last few years, and the volatility has only benefited India's capital markets. First of all, I would like to talk about the futures and options volume, which we have seen. Like, if we just look 5-6 years back, in 2019, volume in terms of contracts, right? The total number of futures and options contracts traded was around 4.7 billion. At the end of 2023, any idea where that volume number must have reached? Any idea from the audience? 20. It reached 80 billion contracts. So that is the volumes actually grew 16x, 16 times, right? The second important trend that has emerged is, as because of the volatility and India's markets moving one way up, in the post-COVID world, there have been hundreds of IPOs because the valuations have been rich. As a result of which, there have been hundreds of IPOs. And even now, at a time when FPIs have been selling in huge amounts, even then, the IPO street continues to be extremely busy, even this year. I'm not allowed to take any names, but there's a big automotive company whose IPO has happened. There is a big housing finance company whose IPO has happened, and there's a very popular food delivery app whose IPO is currently underway, right? All of these are massive IPOs, and all of them are easily getting subscribed, right? The third trend is the rise of algorithmic trading. Now, if you look at data from NSE 2014, right? Roughly 30% of the trades were manual in nature. Means there used to be people who were sitting on the computers and they were manually punching those trades. They were not using algorithms. If you look at it now, that barely accounts to 6 to 7% of trades. And a bulk of the, if you look at point 1 of volume increase, and the second thing is this particular data point where algorithms have taken over, that basically signals the rise of high frequency trading firms, which have started operating in India, especially in the past 5 to 6 years, right? So these are the major trends. I think volatility has only benefited India's markets, though it has not exactly benefited every other global major economy. But yes, for India, it has been very benevolent so far. If that answers you, Naina?
Yes, it does, Manan. And I'll connect it back to what Pankaj said, right? He said take advantage and convert your knowledge into your advantage whenever there is any situation in the market. It doesn't have to be adverse at all. And I agree to you, volatility actually has benefited India. And I think it's just the start. We're just scratching the surface, if I'm right. Right? I think it's still a long way to go. How many people invest in mutual funds, invest in financial markets? Probably the awareness is just getting started. Increase in per capita income, increase in change in consumption patterns, awareness, younger population. I think all of that is only going to contribute to the betterment of India. And I think the volatility, the interest rate fluctuations, the change in rates, geopolitical tensions, we spoke about a lot of things happening around the world, might only come to our advantage. I think we are in the right place. With this, I think I will now move on to a topic which probably is very, very relevant today when we have a change in government in the US. Globalization actually opened up the world in 1991, right? And since then, it's been shaping the global economy and actually contributing very, very positively to our social economic outcomes. But however, as of today, we see a rise in protectionist measures around the world. There's a lot of trade tensions, geopolitical challenges, border restrictions, and all of this is actually challenging the future trajectory of globalization. Again, this is a view. Now let's see what our industry leaders have to say about how this impact of rising protectionism, especially for India-intensive industry like manufacturing and technology, might impact. And Animesh, would you want to take this question, please?
So I think it's a very interesting question because in my mind, it's just part of playing the game. These changing policies or protectionism discussion that we are hearing around us, it was always there in some shape and form. It's more of it just comes out like a big news and people will start panicking. But when the industry is growing, I believe nobody bothers much about it. But when these challenges come, so suddenly there is a policy change, that's where the differentiation of the organization that we are leading really comes into the play. So that's the fun part of it if you ask me as leader. It's more about adapt and reinvent. If we are on the playing field, we are on the playing field. And I believe, and as Mr. Trump, Nana has highlighted, I think it's a flavor of the maybe years to come, because right now all the discussion is how the protectionism is going to play out in one of the biggest market for India, which is US. And let me pick up example of Infosys, and I've been part of many companies, but Infosys will always stay close to my heart, being my first company. I think that emotional connect never goes away. So around 10 years back, they had around 80 to 90% people who were sent from India, and 10 to 15% workforce in US were the local hires. This is around 2013-14 kind of time frame. And when Mr. Trump came with the high protectionism pitch, which actually got him into the power, all of us know the rejection rates of H1 visas and L1 visas skyrocketed. I believe H1 visa rejection rates were around 4-5% before this 2015 hardline protectionism which started for technology industry, and it peaked around 15 to 20% when we are around 2019 to 20 time frame. It was pretty high. And L1 visas, though if we see the government statistics, it peaked to let's say around 30%, which were in less than 5% before that. But we know as technology leaders, the rejection rates were almost high as 70%, because the government data is for all kind of fields we are talking. The technology sector, those were extremely high L1 rejection rates. So what eventually happened? Eventually what has happened, the 80-20 mix, or which we are talking in 2013-14 time frame, now as we stand today, almost 60 to 70% of Infosys workforce is local. And 30% is something which is sent from India, still on these visas. So the way company was operating, it has changed. They have adapted and reinvented themselves that how to hire local, how to train local and manage local. Because obviously the delivery execution challenges, hiring challenges, training challenges, those will be very different. But it is about adapting and reinventing. One more law which Mr. Trump got in his last tenure, which unfortunately did not go through. He wanted to increase the minimum wages for H1B visa holders. But what interestingly has happened between 2016 to 2024 H1B visa wages have gone up by an average of 4% over last 8-9 years, which means almost 40% increase over last 8-9 years. And basis my understanding of the industry and the colleagues that I talked to, H1B visa holders have almost 20% to 30% higher salaries compared to the local hires. Why it is happening? Because Indians who are there and with H1B visa, they can switch to any company. When it comes to local hiring, finding talent is still a challenge. It's very easy for H1B visa holders to change the company they are working for, so the demand has gone up. So even if this particular law comes in terms of increasing the minimum wages for H1B visa holders, I believe industry has already baked it in. There will be no impact of it, or there will be a minimal impact of it. So protectionism is just one part of, because these things will keep on coming. Suddenly we'll see, okay, so let's talk outside US as well. In Australia, and this is I'm talking almost 12 years back, in Australia if we sent an Indian, the first year salary is 10,000 Australian dollars higher compared to hiring an Australian. It is there since last 12 to 14 years, but nobody talk about it, because this has become part of the game. So it's more about if you already know it, then you have to adapt on it. Same goes for Europe. Europe also, the cost of sending a person versus a local hiring, if you can find a good talent, of course, that is still a challenge. The cost is much higher in the first couple of years. So all these protectionism talks, I believe in long run is going to help a company which can adapt and reinvent. And the discussion on if the interest rate cut happens, I believe this is going to be a real capex and opex boost for the technology industry in general. A lot of money is going to flow in over the next few years.
Thank you, Animesh. Yes, when I first hear about protectionism, my first thought is that it's taking us 2 steps backward. It is definitely hampering growth, because I still believe world is in global market, and it actually poses better opportunities when we do not have such trade barriers. But as Animesh said, I think yes, it is all onto the company to adapt, reinvent and establish. I think one of the best examples is Russia-Ukraine war. We thought after the war, usually an economy collapses, right? But I think we are seeing in both the economies increased consumer spending, because there are trade barriers. They are forced to reinvent. They are forced to find opportunities in their own countries. And that's exactly like human evolve. But I still believe that for a global economy to thrive, trade barriers probably is a barrier. What do you think, Durgadas? That's my view.
Yeah, good morning. On the technology front and adoption of technology, sometimes the barrier becomes a boon. To just give an example, I work for a company where we have a data center in Germany, which is one of the top 5 in terms of search results per second. The search result goes more than 100,000 clicks a minute. So these kind of things with one data center, it was a risk as well, because there is no backup. Latency is a problem. Now with protectionism, specifically coming from China and Russia, earlier we never used to do business with Russia or China. And now if you are looking at the protectionism, like things in India, Amex was not allowed to sell its credit card in 2022 because the data localization was not adapted. Similarly, what happened with all the accountants we know here, the account books have to be in India after 2023. So these kind of data protection has helped in faster migration into cloud. We are almost spending 1,500 man years to move from data center to cloud today. That is an improvement which is there. It would have happened in 3 or 5 years down the line. Now that with the protectionism data requiring in the respective countries, cloud is the only solution. That's giving a good boost is what my take is. Similarly, in the technology sector, there is a good amount of protectionism, probably bringing back to onshore the manufacturing like semiconductors. India is spending in PLI 76,000 crores, which is almost $9.5 billion. If you compare it with US, by now they have spent almost $51 billion for semiconductor grants and loans with an investment of $380 billion in semiconductor. The bigger part which I feel is negative is the trust factor. After what happened in Ukraine war, $300 billion of Russian US dollar assets have been frozen. That is giving a trust factor. People are not willing to hold US dollar treasury bonds anymore. In the last 2 years, there is almost like 2.5% reduction in US treasury bonds held by the various central banks, non-US central banks. At the same time, China is buying gold like anything, 250 tons of gold in 2023. The price of gold has increased from $1,750 per ounce to $2,700. And you would see the trust factor in India as well. India is no more holding much of the gold in Bank of England. It has transferred almost 200 tons of gold. So the big challenge which I face is also the trust factor with various governments not believing in each other, while the boost in technology adoption I think is a very positive point for me. Thanks.
Thank you so much. We've been speaking a lot about geopolitical tensions, our inflations, macroeconomics. And that takes me to a very interesting topic that Jayesh leads, risk management. I think it's very, very important, especially in this kind of unprecedented times changing. I don't think the strategy that we had 4 years ago, we can copy paste and say, okay, let's follow this and we will be successful. And our risk management requires continuous revamping, continuous revisiting, and continuous updation to manage our risk. I think geopolitical risk has become one of a very important factor to consider in terms of investment. What advice or what kind of risk management strategies would you advise the investors and the business houses in this times of volatility?
Sure, Nana, thank you. And it's I think, a very, very relevant question in today's times. I think that was a point that was also alluded by the students when they made a presentation, and by the way, it was a very excellent presentation. I'll probably try to break the question into 2 or 3 parts, I think, in the interest of how students would like to understand it. First of all, when you talk of a risk, what do you talk of a risk in context of what? It's risk in terms of your revenues, it could be risk in terms of your cost structure, or it could be risk in terms of your cash flows, right? Because this is where you obviously see the risk. Now coming to the geopolitical scenario, again you want to break it up into multiple categories. First, obviously the geopolitical tensions, that is tension between different economic zones, if I may say, not just geographic zones but also economic zones. For example, US versus China, or maybe Russia versus Europe. That could be one part. Second part of geopolitical uncertainty could be to do with the political transition itself, right? Because if you looked at the year only gone by, I think it was a year of mega elections. There was election in India, of course, one of the largest democracies in the world. The US election just happened a few days ago. UK went to town with elections. France went to town with elections, right? So if you went a year ago, there was a lot of uncertainty in the market in terms of what kind of government will come in play, right? Because today, those days are gone when you thought a government would continue for ages together. You probably will give a government, a 5-year term or a 4-year term, but the government has to think twice before it wants to get elected again, because the investors or the electorate is not very patient anymore. The third would be the slowdown in the economy. For example, what China has faced in the last 1 or 2 years, maybe for multiple reasons. The fourth part would be inflation, because inflation again is a very, very key factor from a geopolitical standpoint, because every country's spending levels, investment levels differ based on the inflationary conditions in those economies, and therefore how their governments, how their monetary agencies are managing the economy from an interest rate standpoint that we spoke of earlier. And last but not least, the local political conflicts, the local conflicts, right? You may, for example, in India, there could be local conflicts. We are seeing a local conflict within, say, Israel alone, right? A Hamas war probably now has escalated beyond the borders of Israel, but within Israel is where it really started. So how are these things being handled by multiple organizations? And that's why I will come back to my point about risk management. As I said a little before, risk is to do with your cash flows, revenues, and costs. And therefore, how does it impact your organization? I think every company now looks at the geopolitical risk as one of the biggest risk factors. I mean, you look at any survey, any corporation, they would call out the geopolitical risk as probably the prime risk that they're looking at. How do you really try to tackle this risk? First is to put in place a framework where you are able to identify this as a risk. And how does this impact you? Today, you may be a corporation sitting in India, but you have operations globally. Pankaj alluded about operations in Europe, Australia, etc. That means you are not just restricting your business operations to your country alone. Therefore, how are you going to handle this thing there? Do you want to simply expand in the country just because it gives you opportunities? The answer may not be no. You have to put in guardrails in terms of how much exposure you want to have to a particular geography or to a particular market. Because any shift in that market, because of some reason, let's say political instability, can influence your revenues or cash flows negatively. Secondly, the products or services that you provide, are you able to diversify to different geographies, different markets, right? Because let's say IT industry, as you know, my colleagues here also will tell you, has been predominantly been getting to the American markets. Many companies have almost 70, 60, 80% revenues come from the US markets. And when there has been a slowdown in the American markets, their revenues or cash flows have got impacted. And therefore, they have begun looking at other possible markets. They have tried to expand into Europe, which is not always an easy market to get into because of kind of labor restrictions are there. They have tried to get into Southeast Asian markets to see if there's scope for expansion there. They've gone to, let's say, Japan, Korea, those markets. So you would actually want to look at different geographies to enter. Party Airtel, if you know, they expanded very heavily in Africa probably a decade ago. The experience may not have been the best of experiences, right? Because those decisions are also fraught with risk. Like how India is like, is a multitude of multiple different states, each having different cultural tenets, and therefore each market is looked at different. Bharti thought that same concept would probably apply in Africa when you look at getting South Africa or Kenya or Zambia, multiple countries. But for them, it did not really work out to the advantage. So they've begun focusing back on the Indian market. Look at the manufacturing companies. I think today they are trying to not just build the exports engine very strongly. Look at auto component companies. They try to expand very heavily to the General Motors and Toyotas or Hondas of the world. But at the same time, they are helping the domestic market grow as well. So thereby they are trying to balance between the geopolitical risk coming from different countries. Services industry, replication may not always be easy. Maybe IT services, yes. But you look at Indian companies, maybe today restaurant chains are trying to diversify into different markets, right? The startups are trying to expand into different geographies where they believe the business will come. Because eventually what they will look at is the risk-adjusted returns. Because they know there is a certain level of risk which will be there in any market which you cannot do away with. But how do you convert that risk into opportunity from a geopolitical standpoint? So that is what they will start to look at by diversifying. So there's some of the, I think, strategies companies are taking. I would also say they are also monitoring the risk very continuously. It is not that I've identified a risk and I sleep over it. Risks are keeping on emerging every now and then, and therefore it's also prudent for companies to look at the risk and start acting on the risk every now and then.
I completely agree with you. I think back when I started working, our risk management framework was an requirement, and you do it for the sake of requirement. Hasn't today, risk management is actively being monitored as one of a very, very important tool that kind of promote the growth of the organization. It's revisited as often as it can. New risks are identified, mitigation plans are put in place, business continuity plans are drafted, and masterminds work on it. So it's as important as running your operations every day. So thank you so much, and you're leading such an important function as well. With this, one thing that caught my eye, by the way, yes, I agree, it was an excellent presentation, a lot of eye-opening facts and facts. One thing that caught my attention was in 1991, and I love this year because it was the start of the... Can you hear me? Okay, so in 1991, I think the GDP that caught my eye was 75 billion. And today we are close to 2 trillion. That's like massive growth, right? Really massive growth. And I think this is just going to double, triple in the next 5-10 years. We don't know, it's so uncertain. We all spoke so much about uncertainty, volatility, taking that to our advantage, taking that to our stride. But what do you think, Pankaj, the next 5 or 10 years holds for the, say, the global markets, and if you can throw light on anything specific that comes to your mind?
Yeah, sure. I would take cues from last 2 years, which I think will definitely impact the financial markets, the global trade. Number one is the climate change, which normally we have been, sort of reading about it, and we have been talking about it, but practically this year people have seen floods. The floods in Indian parlance, we were used to say that UP, Bihar mein hota hai flood here. Now it has come to the western world. You talk about a country, even Switzerland, Italy, Spain, they have floods. Even as of today also, Spain is having floods. So how does it, impact the trade? How does it impact the future of global trade? They will definitely impact the supply chains, and they will impact in a much, much bigger way. I strongly believe that this should be factored in. Number two, which I believe will definitely impact the global trade is, although people believe that dollar is strengthening every day, but I strongly feel that in the years to come, not, I'm talking about 5 years or 10 years, something like 10 years to 20 years, there would be a parallel currency. Which currency it would be, I'm not talking about the western world, which is Japanese yen or GBP or euro or dollar. I'm talking about other than these 4 currencies. There would be definitely a currency which the western world does not like. And they saw what happened when there was sanctions were placed on Russia, and the whole of the dollars, about $200 billion, more than that? Yes. I think more than $200 billion got blocked, and $300 billion got blocked, and the whole world, including China and Asia, they thought this can happen with us also. It can happen maybe 5 years down the line or 10 years down the line if we do not make something new currency, or it can be Chinese currency, it can be, I don't know which currency it would be, but this will happen in something like 1 decade to 2 decades from now. And in that direction, if you have seen, there are meetings which are happening, which happened recently in Russia, Kazan, and people were talking about, let's have a parallel system where we derive the valuation of each country, because it's very difficult. We have been adopted to, everything is pegged to dollar. So we say, okay, my currency is, say, 84 rupees per dollar, and so it's easy to trade, it is to decide. Today, we import a lot of crude from Russia, and that's happening in Indian rupee. But now the problem with Russia is, what to do with this rupee? The rupee is credited to Indian bank accounts, and they are saying what we should do with this Indian rupee. Let's convert into a currency which has some meaning and which can be used. So these are the 2 major things which I strongly feel that they will impact, and in that direction we should start thinking that how the global trade will look like when these 2 things happen.
Thank you, Pankaj. Another thing that caught my eye on the presentation, and looks like I should have been a good student, but was that by 2028, India would be the third largest economy. That's exactly the projection that was put on the presentation that you all presented today, right? I think in addition to what you said, sustainability would be the focus for the next 5-10 years, and everything that the economies are going to do, the corporates are going to do, the business houses are going to do, it's going to be around sustainability. With this, let's shift to our topic of financial markets, right? And I've been told that the bull run is over, and I'm not sure if the bull run is going to continue for the next 5 years, 10 years. They say that it's only, we haven't even catered to our 50% population who are invested into mutual funds, which means there's still opportunity for our domestic investors, and we don't have to rely completely on our foreign investors. Having said that, they say 1 in every 5 households are the ones who invest in equity markets or bond markets, which means we still have an opportunity to include the other 4 households who don't. With this, is the bull run over? Manan, what do you think, and would you want to give us some tips to make some money?
So first of all, I am not supposed to comment on whether the bull run is over or not. But what I can say is the market operates in cycles, right? It operates in bull and bear cycles. And the only way to look at it is if one cycle is over, maybe the wheel, it will take some time to turn. And again, we'll see happy days again. So as someone who is a seasoned investor, people should not be worried about bull and bear cycles. Rather, what I would, like what Pankaj mentioned in his keynote address, people should look to profit from every opportunity, whether it's a bull opportunity or a bear opportunity. The person who has finance at the core of his mindset is not perturbed by the fluctuations. He loves these fluctuations. So yeah, having said that, also in terms of macro trends, I think I would like to add to what Pankaj said about climate change. Yes, we have been seeing floods and similar kinds of situations, but till now these are still localized situations which are having localized consequences. But climate change is actually staring at us in the face. If we do not look at it holistically, we can face a situation where there will be mass migrations of populations, and then other countries which will have to absorb these populations. It will lead to a lot of cultural issues, it will lead to a lot of socio and economic issues, and it will have an impact on the economic policies, fiscal policy, monetary policy, and it will impact the global markets, right? So it is more than just localized issues. Now we need to look at it at a global scale.
Thank you, Manan. And this, I think, justifies the investment that each of the government is making into blue and green revolution. So yes, of course. Having said that, let's move on to a topic to emerging markets, and India being one of the emerging markets. Emerging market in total contribute to 50% of the world's growth. And everybody talks so highly about emerging markets. There are ample opportunities available, but at the same time, there are few challenges that they pose, right? The ample opportunities in terms of their emerging market, untapped, lot of growth potential. There is a lot of significant younger population available. There is workforce available. But then there are challenges like infrastructure. There are challenges like talent availability as well. While we speak about the labor workforce. So I would like to ask this question to Animesh. Animesh, what do you think are the challenges and opportunities for emerging markets?
So I think at the end of the day, as finance professional, it's all about risk and reward. That how much risk we should take to earn the certain reward that we are looking for. And in terms of emerging market, okay, so let's talk about the risk part of it, because at the end of the day we are talking risk and reward. The financial evaluation is pretty straightforward from the perspective of I'll be putting this much money, I want to get this kind of return from the money which I am investing. But at the end of the day, it's a risk that we are taking to earn that money. So how will we evaluate that risk? And there are maybe 20-25 categories of different kind of risks that we can talk of. But I'll tell you the 5-point framework, what I believe is something which has really helped me in diversifying to different countries, that includes the countries in Latin America and for that matter even in Africa. So the 5-point framework which I use in terms of risk is cash risk, currency risk, compliance risk, execution risk, and the 5th one, which no textbook ever taught me but I learned from my own hard experiences, is ownership risk. So these are the 5 things which I usually follow whenever we are talking about getting into a new country. And let me go slightly specific into it. So when we talk about the cash risk is as simple as I'll earn money. Customer has asked me to do something, I have delivered that work, customer has paid the money. But customer has paid the money in a certain country. How will I get that money back to India? It's a pretty fundamental risk which happens. And I'll give you an example that one of the deals which we are evaluating, where customer wants us to work from 5 different countries in Latin America, I believe Guatemala, Nicaragua, Honduras, all these countries are there. Good margin, 40-50% margin. But if I have to take out my money from Nicaragua or Honduras, I have to pay almost 20-30% as the withholding tax, which I cannot reclaim because I do not have a physical presence or cost in those countries. These are the real risks that we are talking. So it's not only about the margin which we are saying, can I get that money out of that country? Second risk, again a very common one, is a currency risk. Currency risk is when I am delivering something, there is a revenue and cost attached to it. The currency in which I am earning revenue and the currency in which I am spending cost can be different. So there is an inherent currency risk. And maybe I'll pick up example of African country, Kenya. So that is something which almost last 2 years, a lot of negotiation has happened with customer on that front. Customer wants us to pay us in Kenyan shilling. We want it to be paid in USD because as of now the only currencies in the world which as finance professional, at least as of now, and hopefully we'll get a new currency soon, which is very important, but because for US it's just about getting a money printing machine in the backyard because it's all USD. So USD, Euro, maybe sometimes Yen or GBP, but preferred mode is always USD, Euro most of the time. Customer doesn't want to pay in USD because Kenyan shilling is continuously depreciating. There's a lot of volatility attached. How will you manage it? Maybe we'll put it in the contract. There is a predefined USD Kenyan shilling conversion rate that we'll use, and if there is a fluctuation of certain percentage, we'll renegotiate it. So the currency, and it's a long topic, so I'll not get into all nitty-gritties of it, but currency risk is real and it can really erode your margin up to 20, 30, even 50% over the 3 years to 5 years period, depending how the currency is moving. Third risk, I will say, is a compliance risk. And compliance risk is also country specific. And let me pick up example of France here. So we were evaluating an opportunity in France, and that particular client had a requirement that you have to have an office in France. You have to have a French-based entity. And to have a French entity, we have to abide with the local compliance. So setting up an office, preparing all my financials in French language basis the IFRS requirement with some customization which is specific to France. It's a huge risk and commitment which is involved. So again, the compliance risk is something which is country specific and it can add to the risk. For example, we are a private company. We do not want to disclose our group financials, but France wants all the details on the table, including the group company. It's a compliance risk. Fourth one, I will say, is a very important one, and it's all about what I believe in my mind. It's about knowing the business. We should know our business, go deep into the business. Execution risk. Execution risk, and let's continue with the France example as well, only. How many people I need in France? How will delivery happen completely from France, or there will be a mix of countries including India? Why number of people in France is important? As a finance leader, do I want to set up an entity there? Don't worry about a branch or a subsidiary concept as of now. That's the same impact when it comes to execution risk. Hiring people on my payroll in France will require me to set up an entity. It's a separate kind of cost which is attached to it. Versus, I go with the EOR model, which is employer on record. There is a French company which will hire people on our behalf so that we don't have to abide by French rules. So which model is good for me financially? And when I say financially, obviously the risk attached to it, because as all of us know, European labor laws are extremely strict. There are a lot of penalties. Letting anyone go is a nightmare. You can even incur up to 2 years of their salary in terms of the compensation cost. So if, let's say 10-20 people, maybe EOR makes more sense to me. But if it's 100 people to business, how real is the business case? Will we really gonna grow? Will we hold people accountable if the growth is not happening? We burned our hands very badly in Puerto Rico. Government provided all kind of incentives if we have a 500 people setup. And the aspiration was for 500. But we never grew beyond 50. So we actually incurred money instead of making money, despite all the benefits which we are getting from the Puerto Rico government. Fifth one, which I will say, is ownership risk, and I will not take a specific example here because it will involve names of the companies or maybe of the people as well. But one serious challenge which I have seen when with respect to the sales team, they will come with all glory picture, boss, the business is gonna grow this, you invest and this will, like, you will make a 5x return and all that. Who is gonna own up that commitment? How are we ensuring that there is an owner who is ensuring that business case? There are defined KRAs along with timelines. Without timelines, KRAs and strategies are just piece of paper. There has to be a single owner who is responsible for setting up a successful business case in a new country. It's an extremely important requirement, and I have seen a lot of business failing because, boss, I am responsible for delivery, I am responsible for sales, I am not responsible for hiring. That creates a real problem, especially when you are trying to go into a new country. There has to be a single owner irrespective of what kind of complexity we are talking, so that there is an accountability. So in my mind, this 5-point framework is very, very important when we are trying to minimize our risk and maximize our rewards getting into emerging countries. Because cultural risk, all those geopolitical risks, or instability around the government, all these are, I believe, that becomes part of this 20 different risk definition which we have. But these 5 points is something which actually help us to evaluate from both financial and business perspective, is it a worthwhile investment?
Thank you. I think very, very valid point where you say not all emerging market is your ground to play, and then ties back to what they spoke on risk management strategies. So and you also give an example of how a company entered South Africa with assuming that it would be a copy-paste situation of India, or Daesh, I think, give an example of that, and how it is not. So it's very, very important when you look at emerging markets. Yes, emerging markets are going to be the magnets which would attract investments of future, right? But it is very important that you assess all of the risks, and risks are pretty higher in the emerging markets. It's very important in your 5-point scale, kind of laid down very, very, very detailed. We'll shift to one of my most favorite topic, technology. In 20 years back, probably, if somebody would have gone to PepsiCo and said, look, this is technology, would you want to try it? The company would have said, sorry, we are not a technology company, we are a manufacturing company, and this is not applicable for us. That would have been the answer, I'm sure. Right? But today, the way technology has disrupted the way we look at our businesses, we look at our operations, it's unimaginable, right? Technology 10 years ago took a long time to catch up. For example, when cloud was introduced, I think it took a long time for people to understand why cloud. It took a long time to catch up. But today, look at AI. Just a few years and we are talking so much about AI, right? I think technology is changing the way we do businesses, we look at our markets, we look at the way finance is being managed, be it corporate finance or be it financial markets. I would want to give an example and then probably go to the panelists to hear from them on what technology can do. And I would give you one very interesting example from my own company, PepsiCo. I'm not sure if all of you have tried product Cheetos, right? So we and if you have read about it, any CPG company takes about 6 months to a year for any new innovation, because there is human involvement, there is a lot of trial and error, a lot of samples get into the market, and they work really hard to get that perfect taste, because they need to work on breaking the ingredients and building it up. Right? Of late, AI was introduced, and it's just not machine learning, but also the cognitive abilities was introduced. 100% automation on Cheetos, and you can go and Google it. It's a very successful story floating for PepsiCo. 100% automation for Cheetos, where the AI broke down the DNA of each ingredient, okay, read the data, in probably nanoseconds, changed the compositions, and built the perfect Cheetos that are out in the market with absolutely no change in the taste, and the customers still love it. It's one of our flagship products. We're really, really proud of the innovation. I mean, this is how it is, like improving R&D, something which was very manual. People needed to work on an innovation. Now it's done, and this was all done in less than 4 to 6 weeks. All less than 4 to 6 weeks. A complete reformulation of a traditional product. So this is what AI can do. And I'm personally working on one of an interesting transformation for the organization, which is integrating consumer planning. I'm a financial planner. So integrating consumer planning, supply chain planning, and financial planning. The most difficult task, but I think we would crack it with the help of AI. Having said that, I would want to pass on this question to Durga Das as to what do you think that rapidly changing environment, changing technological innovations like AI is going to impact global financial markets?
Yeah. Thanks, Naila. Now on AI, a buzzword for quite some time now, and I would like to break this up into two parts. When I say break up, one is AI itself, because we try to mix AI with Gen AI. So these are two different things. So let me start with AI, then go to Gen AI. And similarly, my experience with the travel industry, and then similar thing with the financial industry. So in travel industry, we are seeing booking of tickets. You try to book tickets, now again retry after 10 minutes, the prices would have gone up. There is something called dynamic pricing, which is there for quite some time now, 15-20 years. If you go to IRCTC, you book on day one or book on the last day, the price remains same. In the airline industry, give a try. 3 of you book ticket from one place to other place. Don't book a ticket, go till the end, don't do a checkout, come back again, do a pricing, the prices would have changed. So there is artificial intelligence and algorithms in ticket booking for quite some time now. It understands who is the traveler. Is it a leisure traveler who travels on a weekend, business traveler who goes on Monday and comes back on Friday, and all these things are there in its algorithms. Who is booking the tickets, reasons, everything. Are you flying with your colleagues? Are you flying with your family, kids? The pricing changes. That being said, what is happening in travel industry in the Gen AI part? In the Gen AI part, the first thing which is happening is using Gen AI to help the customer. So we have a good amount of chatbots being given to travel agents and the back office to help the travel agents, the customers, to get responses. So when you call and get some explanation on the travel details, the agent looks at these chatbots, which have been fed with a lot of old data, and a new Gen AI has been formed, and also using that, the accuracy levels have been increased significantly. Also the timelines when these responses are generated, it's happening now. That will also come to the customers. Now customers, the chatbot is not that great. My experience with the chatbot, and maybe you guys, is not great. It is going to improve. Where it will lead further is, instead of booking tickets or planning an entire trip, which is happening today in bits and pieces, wherein I do a drop-down menu, put some text, dates and other things for booking a ticket. I think very soon there will be platforms coming you can give a text question saying that I want to go from this place to place A to place B. on this date or maybe this date. My layover, I would prefer to have a direct flight, if not a layover not more than 3 hours. The price could be from 1000 INR to 1500 INR. And with all these constraints and requirements, there should be tickets given to you. That will be really good, because today when I look at the population, maybe 10 or 15% of the population has got to know how to go to an airline ticket or a website and book tickets. But everybody knows how to speak. So vocabulary converted into text, requirements in different local languages will definitely increase the market size. That's where I look at the technology moving on travel. And if I take the same example to the financial markets. Now in financial markets, we have the mutual funds wherein there is a lot of active funds and passive funds. Now when I look at the US market, which is more developed, the active funds, 85% of the active funds do not even match the S&P 500 index. They are trailing the performance. So what has happened in US is, in 2010 there was 17% people investing in passive funds, and in 2023 it has gone to 48%. And in India it has grown, the asset under management, I couldn't get the percentage, but asset under management has grown up 17 times in the last 10 years. So this is the growth towards passive funds. Why I'm saying passive funds? Now passive funds can be managed much more easily than the active funds. So using artificial intelligence and Gen AI, it will be easy for the fund houses to manage these funds at a much lower cost. Of course, we do have a benefit of active funds being costlier and passive funds being cheaper. But that being said, just imagine the passive funds being managed automatically by using intelligence. And what happens with the Gen AI? Gen AI can be a support to the fund managers. The fund managers can ask questions or to the languages which are being used to find out which fund to be invested in, which company to be invested in, what will be the economic trend and stuff like that. And it will provide a lot of input for the fund manager to decide. The technology may not be developed to replace a fund manager, but a fund manager can absolutely take advantage of Gen AI maybe in a year or two. I feel that it will be a very fast adoption wherein the fund manager can use all these Gen AI tools to get an understanding. Also reiterate what his thought process is, that this is my think process, can you validate it? So validation of this will be absolutely good in terms of the AI and Gen AI.
Thank you so much. Just one point to add, right? AI works on data. The more the data, the more the results are better, right? And hence we should not forget how important data architecture is important for an AI to make a decision. And other common thing is whenever we hear AI, we panic. And I think that's absolutely not necessity at all, because it's going to create more opportunities, it's going to create more power, it's going to give us more knowledge to act faster, better and smarter. And I think Nimish, you had some point to add.
So I think excellent point, Nana, on the data point, because that's what I also wanted to highlight. Any AI innovation that we are talking is function of the quality of the data and the number of data points, of course. And I believe one very, very important differentiation is between the kind of business that we are in, because in a B2C business, there are lot of data points. So these AI analytics and possibility of using dynamic pricing, as Mr. Durgadas was explaining, these possibilities are real. But barring the B2C business, coming to B2B business, the number of data points will be less. Lot of these data points are inward looking, or the number of customers that we have, again, is a finite number of data points that we have. But that comes back to the original point which I was making. Please know your business. That is the most important part as a finance leader that we have. Because initially, I also, when I was thinking that what we can do using AI and Gen AI, I came up with hardly any answer where I can use it in finance for a B2B business. We are into a B2B business. But thinking aloud, eventually, the few of the things that we identified, we can actually predict attrition rate of our employees along with the names, people who are at the risk of leaving. Very much possible. Inward-looking thought process, this is the business. We can even predict what kind of rating each employee will get. So we can work on the course correction, we can ensure our possible top performers are taken care of. Or I can even predict my win rate basis the name of a specific sales guy in a specific country. That basis that I will ensure which sales guy should get more support or funding or a lenient point of view when it comes to the investment decisions. So for a B2B business, how we'll use AI and Gen AI will be different than how we'll be using for a B2C business. I just wanted to highlight that point.
Thank you, Nimesh. Desh, you're part of Businesssoft, and I'm sure you know much more than what we know as part of our end users in terms of technology and its advancements and how it's going to impact markets, especially financial markets, if you can add.
Yeah, I think both Durga as well as Unmesh have spoken about how AI is getting used today, and the applications are never going to stop, right? I think technology is at the very forefront now. If you remember, last week the NVIDIA CEO was in the country, and he said India should not be a back office anymore for AI. He said we should be the front office for AI, which means he genuinely believed the kind of talent and applications that can be used within India. I've been a part of the technology industry as well. Even my organization develops a lot of applications for the clients based on Gen AI platforms, right? We internally have a platform called Cogito, which we use for multiple applications for the client. Obviously, for confidentiality reasons, I can't disclose so much about it. But I also, as I said, wear the risk management hat, right? And I just want to also highlight some of the risks that come with, the pervasive use of AI. One, as we use more and more AI-driven data system, because the basic building block for AI is the data, right? We use more and more data-driven systems, the AI data-driven systems. It gives a larger canvas for the cyber hackers to play, right? We spoke of geopolitical risk, but most organizations are now realizing that probably the number 2 or number 3 risk hierarchy is the cybersecurity risk. Because cybersecurity risk is now getting emanated in multiple forms which you're not even aware of. And therefore, with the kind of data that is in play here, it is becoming very, very clear that this is a play for the cybersecurity, hackers, etc. So this is one big risk, I would say, coming from AI. Secondly, will it displace labor in different organizations? That's always going to be a point of conjecture. Some of the low-level jobs, especially in the BPO industry, where a lot of automation, AI-based automation happening, can mean that their jobs can be disposed, especially when their routine tasks can be automated. There could be AI that could be supplementing people to improve the productivity, but there could be a low-level jobs getting displaced. India is a potential, seeing it as a potential threat. Other countries which have been very strong in the BPO space, like Philippines, have also, have begun feeling the impact of it. Eventually, who probably will benefit? The profitability of the companies may go up, and therefore the capital owners may benefit, not labor owners. Third point is eventually artificial intelligence, right? It is not natural intelligence. So you are working on a lot of algorithms in AI which help you determine how the decision making happens. So if you strictly decide I want to only go by AI, sometimes you may end up making wrong decisions. So these are the few facts which we should be always mindful when we take decisions for AI. Use of AI is going to be all pervasive, there's no doubt. I think it's already pervaded all our lives. Our cell phones are fully of AI, right? You go to a website and I'm sure the next moment another website will pop up and say, okay, is this what you're looking for? Whether you go to Amazon, you go to a travel site, you go to Ibibo, or you go to Make My Trip, this will happen. Which means there is a lot of data privacy issue as well. Can AI also lead to data privacy being invaded, who knows about your whereabouts? Only you should be knowing. But today, if somebody else knows because of how AI is trying to pervade your lives, I think that's going to be a big risk for us. And last but not least, we've spoken of governments, right? The regulations haven't been able to keep pace with the changing pace of AI. Because governments want to be very, very secure. Today, AI can be a big security risk as well for governments. But are our regulations in place? Data privacy wise, security wise, the answer is no. So the regulators, the governments are still grappling with this risk. And they want to ensure that they stay one step ahead, but the technology can be much more faster. So these are some thoughts I will leave with the students as well. So when you think of AI, think of a lot of these things in the background as well, right?
And I would just like to add one more thing. So what Daesh mentioned was at a industry level, macro level. But I think for you all sitting in this room, right, you are at the cusp where your career starts. You must have seen the previous generations. They have been employed in one particular industry, one particular vertical, and they work their entire careers in that industry. I think as the generative AI and as the algorithms, their strength and their potency it increases, and Daesh also touched upon the aspect of people losing their jobs. I think for you, what matters is that having a long-term career in one particular industry might actually become increasingly difficult for you. And it's not because of your competence or your skill, but because of the changing nature of the industries, right? So you will be having such periods in your career where you will have to frequently either upskill, reskill, or you will have to look at some greener pastures somewhere else, and you will have to constantly reinvent your career. So it's a big task for you. You should always look at those inflection points and calibrate your career, your aspirations accordingly going forward. So that's an impact of the AI which people don't realize, but yes, it is out there.
So, sorry, just 10 seconds. So I just add to the point which Manan made. I think you as students, and very soon you will be leading all these discussions in the organization. I think using AI ethically is on the top of the list when you go through the AI guidelines which anyone talk about, because there is no end to how the AI can be used in terms of privacy invasion or how deep you can go in anyone's life or the way they think. It can be as simple, okay, and I'll not name the company here, but I know there are companies who are even storing the data on the day-to-day conversations that you are getting, which you are doing inside your homes. All these smart homes have created so much data which can be in wrong ways. So using AI responsibly is very, very important if we want it to be a successful technology, instead of maybe talking it in not a very nice way as 5 years down the line. So using AI ethically, I believe, should be on top of the list for all of us who are in this room.
Thank you all. I will just leave with one last note. In 1990s, when computer was invented, all the accountants thought that they would vanish from the face of the earth and we would not need accountants and finance professionals. But look at yourself. Look at the class, the number of people sitting and still doing finance. So artificial intelligence will still be artificial, and with that note, I would want to make this a little lighter. I think we spoke too much about risks and opportunities, but let's make this lighter and let's get a little more inspired from this leader. So first question, Daesh, if you were a social influencer, what is that you would be promoting? Not finance, of course, and not risk management at all. What is that you would be promoting?
I would rather promote less usage of social media. Right? I think we're getting too carried on with social media, right? As I said, we really do not know how much it has really invaded us. So if I were man on social media, I would say use less of social media and keep on saying that. So maybe I'll make my usage more on social media, but try to get your usage down. Eventually it will be a zero-sum game.
I'm sure no one here like you for this response. They're all looking at their mobile right now. So Durga, that's a question to you. If you are asked to go on a coffee date Unfortunately, not with any of the celebrity, but with one of the philosophers. Who would that be and why?
First thing is, this will be a bit longer answer.
I'm not hungry. I'm not hungry at all.
Okay, because thing is, one, Indians are not philosophers, Indians are seekers. So if somebody wants to give their philosophy and a template to me, I will say no. I will have my own template for my life, and I don't like somebody else's template. So since you guys are very young, I'll share my template, very simple. Every one of us would go in a waterfall model all through our life during our education. We have schools from June to September, then again come back to school and then go back again in vacation where we play. During school time, no play, while playing, no school. That's not a template which I like. I like a template where you do everything every day. If not everything every day, maybe a week or a month. Long year is too long. Don't wait to have a template where it says, I will start working at this age, I will stop learning by when I start working, and after that I will go on vacation, I will retire at 40. Doesn't work. So do everything at the same time. When I say everything same time, time may not be a day, it could be a week, month, or even a year. Enjoy your life on every single day. That's my template.
What a valuable advice, but your coffee is wasted. Would you want to pick up a date?
No, I'll drink it with myself. I enjoy my, when I go to Punjab, I always like that movie, Jab We Met. I love myself a lot. That's what Karina says.
My only favorite.
My only favorite. So, that's what I like.
Okay, Marlon. So, one of your failures that you actually love and cherish.
Okay, that's a tough one. Fine. At the risk of not providing too much of insight into the personal life, but yes, when I was 21, I was preparing for CAT, and at that time there were only 6 IIMs. I had just graduated, and in my final year of graduation, I had given the CAT. And for some reason, I don't know why, I had this weird confidence that yes, IIM में तो admission होना ही है, मतलब हो ही जाएगा, but कुछ नहीं हुआ. And then I started searching for jobs, कोई jobs भी नहीं मिली. So it was a very, very troublesome period of my life. It forced me to think, rethink, and then strategize on what I wanted. What was the best in me. It helped me to, think sensibly, logically, without any airs, without thinking of myself as a God's gift to mankind. And it basically did a lot. It was basically God talking me down on certain things. And I was after that, I think it taught me the value of hard work, of planning, and I think it was really a very, very good phase in life if I look at it. Yeah. But also one more thing, circling back on what Dayesh said, if you say that use social media less, then I would be your biggest opponent, because I absolutely love the reels and the memes stuff. And I make it a point to dedicate at least 1 hour a day, that is generally towards the end of the day, watching the stupidest of reels and memes, because it actually keeps my mind fresh. It keeps me, it keeps me in a happy mood. That's my kick of dopamine. And yeah, I mean, so nothing is bad, everything is good. Yeah, social media to a lot of extent, it depends on how you use it. I use it for creativity.
Just didn't join IIM so that you can sit on the dais of IIM today. Animesh, question to you is, if you can go back in time, when would that be? And not just your lifetime, but back in time, any time. When would that be, and what one change you would do to the world or to yourself?
So, honestly speaking, I believe, at least as an individual, I don't regret what has happened or what I could have done differently, because where I am today, I am there because of all the good and bad experiences. So it's more about focusing on the solution rather than the problem when we are going through the tough time. But if I get a chance to change few of the things, maybe two things I'll say. One is, I still remember one of the most important advice I got from my senior on my first day of MBA. Make this year count, don't forget to have fun. I did not get what he meant at that time. But after clearing my MBA and getting into job, I realized what he meant. So I ask all of you, obviously focus in your studies, but please do find to have some fun as well, because you are going to cherish this time forever, trust me on that. Second thing, maybe if I get an opportunity to go back in time, I'll buy a few of the stocks like Google, Amazon, Infosys.
I think Asian trades, 2001.
Yeah. Oh, Titan, oh, wow. What growth.
I would have the money of today, go back in time and then buy the shares. Because if I go back just in time, I didn't have money to buy that as well.
Not be affected.
Okay, so the last question to you, Pankaj. What advice would you give to your younger self? To your younger self? Okay, younger self, when you were just born.
Okay. See, I came from a commerce or what we call accounting background, BCom. You know, most of the people hate being a commerce student or an accountant. We are tagged as accountant. If you go about 30 years ago. So I would say that how do I convert my accounting into something which is creative? Because normally an accountant is not considered to be a creative person. Creative is more linked to sales, marketing, art. But I would have, if I would have advised myself, that I would have been more creative towards the first phase of my life, which is the 90s, where if I had been more creative, I could have changed more and more to myself as well as to the organization where I work. But sometimes I find cues where I really did something, but that was too small or too meager to quote at this moment. That even handling a small situation, I'm talking about a situation in Pepsi. I was working there for 94, 95, very long, 30 years ago. Day one, when I joined, there was a meeting going on that we want to collect, and Pepsi, if you know, is at that time was not a cola company, it was a tomato converting it to paste and selling it as a paste. So they were talking about that, farmers are not giving them tomatoes on time, they sell in the market, and they were facing the situation that, and there was a problem from accountant also, that how do we pay them on time, and they were, list of problems, and there was no solution. So the boss said, Pankaj, you are new, why don't you also speak something? So something, what would I say, Ajib Sakam came to my mind, that let us produce a tomato which cannot be sold by the farmer to anybody else. So how is it possible? We produce a tomato and it is not being sold by the farmer to anybody else. He sells it to us only, which is meant for us. So he said, what do you mean by that? He's normally, as a common person, we believe that tomato should be red, it should be of a normal size, and it should be juicy, and it should not look like green. So do opposite of that. It should be bigger. It should be something like 400 grams of 300 to 400 grams per piece. It should look ugly. Ugly in the sense that it looks like a kaddu, then you won't, buy it. The farmer would not be able to sell it. And it should have some more juice, because that is the juice which is required to convert it to a paste. He said that is brilliant, but that will take its own time because we need to, make the breed. But he picked up this particular aspect in me, and he said, why don't you convert your accounting knowledge into more commercial sense and make this happen, that we do something in accounting too, which helps us in collection of more tomatoes from the farmers. So that we did. That's a long story. If I take this time, that will take another 30 minutes. Thank you.
Thank you, Pankaj. With this, I would like to thank my co-panelists for their immense contributions, sharing their experiences and giving a lot of tips and advices. And I would like to conclude by saying that unprecedented times, a lot of volatility, a lot of macroeconomic disruptions, but this is the best time to be in the industry where the finance function is transforming itself from traditional finance to becoming a true business partner. So we all wish you, on behalf of everyone, I would like to wish you all the very best. Get the right competencies, get the right knowledges that are required to be the true business partner to emerge as the most successful finance professional in the world.
We extend our heartfelt gratitude to our dignitaries for enriching this session with their valuable expertise and wisdom, making it truly enlightening for our students. Now, I would like to open the floor for the questions.
Sir, good afternoon, ma'am. Thank you for such an engaging and knowledgeable session. I am Mehak from MBA batch, and my question is, in the context of deglobalization trends, how might financial markets respond to increasing regionalism in trade and economic policies? And what role does geopolitical tension play in financial market volatility, and how can investors manage risk associated with it?
Thank you for the question, Mehak. See, when we use the term global liquidity, right, you should focus why that term liquidity has come. Liquid is what? Something which is fluid, right? And like water, it flows. Will there be obstacles for that water to flow? The answer is yes. Will there be resistance? The answer is yes. And therefore that liquid will path the path of least resistance. There's no path of no resistance. There's a path of least resistance, right? And this is exactly what the investors will start looking at. Where do they believe will be the least resistance compared to and relative to other resistance points, right? So as I said, geopolitical is one. What's also, I mean, maybe I would have mentioned before, you are also going to find alliances happening between countries, right? You will start favoring trade with countries with whom you are politically more comfortable with. So politics and economics will start coming together, right? So you will have those trade blocks all over again. We used to talk of trade blocks 20 years back, 30 years back, and we said all the trade blocks have gone away now. But the trade blocks will start coming in again. Let's say, for example, India is now more compliant or more friendly with America and its allies, right? I'm sure the doors will be more open for India to do trade with the US and its allies, right? Europe will find the same thing. Why? Probably you may have China as a common enemy, quote unquote. I will not use, may not be the right word to use, but you may not want to do trade with China. A lot of manufacturing in the past was focused in China. In 20-30 years prior to today, China has made humongous investments. So China was the manufacturing base for almost everything outside of the country. I mean, American companies most likely depended on China for all its production. But what happened during COVID? The supply chain stopped completely, right? Car production stopped, machine production stopped because China had become the world's production or manufacturing market. That is where the relation came that we should have other manufacturing bases. That's why countries started coming to India as maybe China, as part of the China plus one strategy, China plus two strategy. They started developing manufacturing bases in say Malaysia, Vietnam, etc. Why wouldn't they go back to Europe? Obviously, there's cost arbitrage not being available, right? You will probably get cheapest production levels in China, but probably India or Vietnam or Malaysia may not be that expensive. So that is how the trades will start playing. There will be a lot of local trades happening. It may not be one size fits all, but what is the best solution for a particular service or a product to be sold? That's where your liquidity will start flowing. And that's where investment will start flowing. I hope that answers your question.
Yes, sir. Thank you so much.
Mark, good afternoon to all the panelists. As we know, the sustainability and the climate change policies has introduced transition risk for many industries and contextual risk for many other industries. So my question is, compliance with the climate change policies and this ESG standards, will it boost the capex and opex across the global capital markets, or will it slow down? Forgot to tell my name, sorry. My name is Bhavin Joshi. I am from MSDSM, batch 01.
Hi Bhavesh. Sustainability and ESG is just an evolving concept, but very, very, very important. The world recognizes its importance, and it would only increase the capex boost. Any investment for the better. Sustainability cannot be a separate investment, right? It's not a separate agenda that you drive apart from your operations or apart from your business. It has to be embedded in your business in everything that you do. And all the investments that any organization in future would be making by force or by option would be driven by its sustainability as well. And more the sustainable option, the more the inflow of capex. I'll give you one example again from my own company. Who thought that growing potato, can attract sustainability and can attract increased inflow of capex, and we are doing it. We are focusing so much on regenerative agriculture, with sustainability as its core, that we are transforming the way we are growing potatoes in conjunction with the farmers, that we can't even think about, it's never been thought about. Just an example that, and to answer your question, it is going to increase capital inflow multi-fold.
And just to add a couple of points on the sustainability. So, in my mind, definitely it's an evolving one, but sustainability will be an integrated part of how the business is actually run. So that's how it's gonna evolve over next many years. I sincerely believe there will be strict regulations which will come around, very specific measurable regulations which will come around. It's an evolving field and it will differ industry to industry. But please do understand, as finance professional, all the sustainability initiatives do come with a cost as well. So as finance professionals, we also have to evaluate again the risk benefit of the sustainability initiatives that we are taking. For example, if we have to, I'm just taking an example, in the technology industry, for example, the definition of sustainability is what? One of the largest US telecom provider wants us to hire a minority subcontractor with a minimum 9% spend of the overall contract value. Okay. First of all, we have to ensure that 9% of our business be subcontract, and all of us know subcontracting a work versus getting it done through my own employees is always more expensive. On top of it, there is a restriction, it has to be a minority, the owner should be a minority based person. The definition of minority, obviously they have a lot of, the person of color or gender, a lot of things are there. But first of all, subcontracting, that too, it's a very restrictive state from which you can pick up. It will have a financial impact on my business. So being conscious about these regulations are coming, start exploring it in advance before it becomes mandatory from all US companies when they are asking for any outsourcing service provider that you should have this. Start developing those relations now, which contractor I should have as a partner with me, and start developing business, which part I can subcontract, which I should not. So start thinking ahead of that time before it becomes a mandatory part of it. But yes, there is a cost involved. Be conscious of it, but please plan ahead. It will be very important. This is the industry you are in.
So I am Deepak. As the sense of increasing investments going the GDP so higher, we are giving more subsidies in the manufacturing PLI schemes. But for example, we miss the part of getting revenue where it comes from. For example, Apple generates most of its revenue from designing. China makes only 10% by manufacturing the Apple products. So mostly more emphasis on manufacturing in India. So we miss the part of designing in the sense by capturing value. So it will more contribute to the GDP than any other else. So does India misses in it? How we are going to cope up with that in the sense?
I think every country would have its own strengths, right? Probably the strength for China was always manufacturing. As I said, there was a significant amount of labor arbitrage that was available in China. And therefore Apple felt it was most economic to do that activity out of China. Similarly, if they believe it's very high-end design, it's the same protectionist policy. Apple might think of doing that work in its own homeland, right? Apple itself has a huge base in Cupertino, where they have super big premises. So they would rather prefer keeping a lot of high-end activities themselves because there are R&D challenges. They want to be very protective about the technology that they are developing. They wouldn't want it to be passed on to competitors, right? So in any business, you will always have these challenges. It's not that India has missed the boat. I think India has its own strengths, right? For example, the outsourcing industry. India today is a 250 billion outsourcing industry, both in terms of the domestic market, which probably was about 40-50 billion, and the rest 200 billion is exports from India. Does any other country have this kind of export? The answer would be no. Right? So every country will have its own strengths. And I think I also give the example of BPO, right? Probably India realized early in its early the IT industry realized pretty early that BPO may not give you that kind of a top line. And India had the skill set, the talent base to evolve into a much more bigger technology player. And that's why the IT industry has boomed over the last so many years. You are now finding increasingly corporations setting up their global capability centers in India. Why? That's where design strengths are. So that is coming in India's way. I think they are expecting the GCC to be a booming industry for India in the next 5 to 10 years. We never know where it's going to reach. So potential is always there.
It's an excellent Thank you. So it's an excellent point which Jayesh made because I believe the Indian outsourcing industry, how it started was cost arbitrage. But over last 10 years, moving up the value chain is very evident because a lot of these design centers and GCCs are coming up in India. Even for example, NVIDIA, I know they have a large presence here. Few of the other chip companies have a large presence here and they are doing a lot of designing work here. Because one thing which I sincerely believe in, Indians have great brain power. So in terms of doing the smart work, it was never a challenge and we are already moving up the value chain. And coming up that why we should focus more on manufacturing, because even slightly if we take a step back, China, because of the manufacturing prowess which they have, because they understand the manufacturing, you can see innovations coming out of China despite all the restrictions which US is putting that technology should not move there. And India already being a powerful player in terms of doing a lot of this design work, with the manufacturing capability involved, they'll complete the value chain end to end. They will have the manufacturing capability, they will have the designing capability, they will have an innovation capability, how to make it better. And India being a populous country, we do need a better infrastructure, there is no doubt about it. We have a young workforce which needs to be involved, which needs to be deployed. From that perspective as well, the manufacturing is important from the overall country moving up the value chain perspective in my mind. So it will complete the cycle from end to end perspective.
I think to add to what he said, just like India has moved up in the service chain, right? In the same way, China, if you look at it, China now, no one goes to China just because it manufactures things cheap. I think today the kind of capabilities that China has developed over the years, they are actually pretty cutting edge, and for very high tech manufacturing is what, at a affordable cost, that is what people go to China for, right? Having said that, if you look at it, if you look at the China's growth trajectory over the last like 3-4 decades, right? I think around 70s or so, 70s, 80s, India and China were pretty much similar on many parameters. The delta in the growth, it started once China started focusing on manufacturing, right? Because manufacturing has that, and obviously, managing their currency in respect to the USD. So it completely became export focused. It led to a mass employment, and then it basically led to an improvement in the living standards of the people, right? So that is what in some shape or form every country tries to do. So if you look at other countries like say Vietnam, right? Again, it is very heavy on manufacturing, right? Bangladesh tried to do it. We are also trying to do it, right? So the path is pretty much set. The only thing is we need to do it in the right way. I don't think the direction is wrong at all.
Thank you to our insightful and engaging panelists for responding to all the questions with alacrity. Due to the time constraint, we won't be able to take any more questions. All the panelists, I request you all to have a seat in the audience and enjoy the conclave further. We would now like to invite Mr. Vignesh Nair to conclude the conclave.
Good afternoon, respected dignitaries, esteemed faculty members and fellow students. I, Vignesh Nair, with immense pleasure, would once again like to welcome you all to the 8th Annual Finance and Marketing Conclave, PARIPREKSHYA. As we gather here under the theme of navigating global macroeconomic trends, unveiling their impact on financial markets, our esteemed guest speakers have beautifully illuminated the critical forces shaping financial ecosystems worldwide. From protectionist policies affecting global trade to technological innovations driving long-term shifts, understanding these trends is essential. This theme encourages us to explore the interconnectedness of our global economy and to adapt to these dynamic shifts with resilience and grace. And now, to summarize some highlights of today's discussions, I would like to begin with the captivating keynote speech delivered by Mr. Pankaj Garg sir, who shared his insights on impact of interest rates on financial markets and the opportunities they bring with their fluctuations using bonds and interest rate futures. Your contributions were invaluable, sir. Next, Mr. Dayesh Angle brought his perspectives to the panel, highlighting how the governments are managing the economy through macroeconomic trends and the ways of tackling risks through these trends globally. He also mentioned about data privacy and the extent of AI in our lives, providing us with an enriching experience. Your insights were invaluable, sir. Ms. Naina Mehta, along with moderating the event, offered a fresh and engaging perspective as she explained the significance of globalization, risk management, sustainability, technological innovations, and artificial intelligence. Thank you for sharing your expertise, ma'am. Additionally, Mr. Animesh Agarwal guided us through protectionism and its impact on the demography of global workforce. He also shared his perspective on the risk and reward effect while getting into emerging markets. Your guidance has been most helpful, sir. Mr. Durgadas Shenoy then contributed valuable insights on how protectionism has fostered data migration into cloud and how it has boosted onshore manufacturing. which brought clarity and new viewpoints to our discussions. Thank you for your time and wisdom, sir. Lastly, Mr. Manan Vaishnav offered his thoughts on how volatility has impacted India in terms of increasing futures and option contracts, booming IPOs, and increasing high-frequency trading firms, rounding out the discussion with a compelling perspective. Their expertise was truly beneficial, sir. With a heart full of gratitude on behalf of the entire IIM Amritsar community, I would like to express our deepest appreciation to all the distinguished guest speakers for enriching our knowledge and setting an exceptional standard for this event. Your presence today has made this gathering a celebration of knowledge. Thank you.
Thank you, Vignesh. Now, we invite you to indulge in a brief but captivating glimpse of today's event. Diligently crafted by 50mm, the Photography Club and Media and Public Relations Committee, for capturing the glimpse of today's conclave. Now, I would like to request Mr. Agam Mittal, Junior Industry Interaction Committee Coordinator, to propose the vote of thanks.
Good afternoon, everyone. On behalf of the Industry Interaction Committee, I am Amritsar. We would like to extend our heartfelt vote of thanks to all of you for making this conclave a resounding success. Our sincere gratitude extends to our esteemed panelists and keynote speaker. Your willingness to share valuable knowledge and experiences has enriched us all. We are truly grateful for your profound insights and wisdom you have imparted. To our Student Affairs Chair and all honorable faculty members, we extend our heartfelt gratitude for your unwavering support and guidance. Our warm appreciation to our respected Dean of Administration, Mr. Surinder Rao Kumera, sir. We truly extend our heartfelt gratitude to Ms. Ruchi Mishra ma'am. We are grateful to have you as a mentor. We also extend our heartfelt gratitude to FEC, the Finance and Economics Club of IIM Amritsar, for their efforts in setting a relevant and engaging context for the event. A special vote of thanks to FEC's faculty anchor, Professor Ravi Khadotra sir. Your unwavering support and guidance throughout the planning and execution stages have been instrumental in hosting this event. To the IT team, thank you for ensuring the smooth running of the event. Your hard work is appreciated. The success of this conclave owes much to the collaborative efforts of the Media and Public Relations Cell, IIM Amritsar. We appreciate the efforts of the Placements Committee, IIM Amritsar, to maintain the necessary decorum at the conclave. We are immensely grateful to 50mm, the Photography Club of IIM Amritsar, for the never-ending support. A big round of applause for the Industry Interaction Committee for making this event a huge success. And finally, to you, the students of IIM Amritsar. Thank you for your constant support, patience and engagement. We are truly grateful for your participation. Once again, thank you to everyone for making this conclave such a memorable experience.
I now invite our dignitaries, faculty members, IIC coordinators, and Finance and Economic Club members for a group photo.